And welcome, everyone. It is Angelo Robles. I am back. Pardon me, my technical capability for being a pinch late. Welcome to it's hosted on StreamYard, but live on most all my platforms. So, very excited to be back. I know it's been a busy July for me as I'm launching my new initiatives, and now we're August 1st, and no end in sight. I am going to be busy. What we are doing a little different today, and I've been really looking forward to this and building up, honestly, some of the experience, is we have a special guest today. Now, it did say 11 to 2. That sounds a little long, but it probably is going to be an hour and a half or a notch longer than that. But don't worry, it's not going to run to 2 o'clock. If nothing else, this seat is way too uncomfortable, and I don't want to deal with this for 3 hours. So, an hour and a half is probably going to be fine. But you do know that I like to get deep. And I think, again, this is kind of missing in the world of wealth and family office world is it's too generic, too light. And this is actually going to be what I would say is a notch less scripted in terms of my questions than normally in my traditional YouTube and other platforms. And I think that's a little bit of the charm of live is it literally is that it's meant to be a little bit more raw and a little bit more interactive. So I'm really enjoying this. First of all, for those coming on again, to really get the full breadth of what I'm doing, you really have to sign up, and they're all free to all my platforms. You have to go to YouTube. I am at Family Office, and that is where your questions come in through this StreamYard program. I may need to look at my phone for the LinkedIn ones. That's just how it is. So it's a little bit distracting, but I'll try. But you should go into YouTube and sign up to at Family Office. That's my older pretty significant channel, and my new channel, Family Office TV. So go in there and sign up there as well. I am active on Twitter, also at Family Office, and on Twitch and new to Rumble. Go and sign up to both. It's Angelo Robles Media. Again, Angelo Robles Media. So this is really, really an exciting time, kind of bringing a little bit of my Family Office TV live and doing an interview on my platforms. And again, at least through my at Family Office on YouTube channel, at minimum, you will be able to ask questions that I could likely see on my platform here and be able to interact them. And also for those on YouTube at Family Office, Super Chat. So I see that. I appreciate your support. It goes to the top of the line. And I'm sure it's going to be a great question where I am just dying to ask that super chat. So today I'm featuring a guest that I've known for over 10 years. When I think back to all the events I've hosted, there's been really a small number of people that always are very insightful. And I've asked my guest from Sam Zell to Ray Dalio to Peter Thiel to so many others. I've been so fortunate, David Rubenstein, to have over the years when I was running as the founder Family Office Association. And this guy asked like the best questions. So to have him on now and to have followed him on LinkedIn and Twitter, we lost a little bit of contact. Well, COVID changed a lot of things, but here we are now. So this special guest today is Ram Ahluwalia. Ram, how are you?
I'm doing great, Angela. Great to see you again. Thanks for having me.
And we will catch up on that beer, scotch, or something. And I do look forward to that. One day I'm going to do a series where I'm traveling around the world, maybe as soon as this winter. Of course, I want to go to warm places like St. Bart's, wherever it's going to be warm this winter. But I also like the cold and I like Jackson Hole and do really like in-person interviews over drinks, over dinner, and probably do them as little clips. So stay tuned, audience. Got a lot of ideas around that, including one or two billionaires that will be coming up. And who knows, maybe I could take Family Office TV one day to Netflix. So we'll see. Put in a good word for me. So Ram has over 20 years experience in banking and asset management. Ram is the CEO and co-founder of Lumida, a digital-first private wealth advisory firm focused on alternatives and digital assets. So today we're going to focus on wealth, on crypto. You haven't heard me mention that word in so long. And I got a guy that knows a lot. And AI. So I know broadly three things, two rather trendy, one in AI, incredibly trendy, but we're going to do deep dives into that and really, in many ways, a whole bunch of topics. So Ram, why don't we begin? You kind of have, I don't know if I call it a saying or a theme, and I love it. Becoming rich. Now, who in my audience is not going to want that? Becoming rich with non consensus actions. Give us some context.
Well, sure. Let me frame it out for you. So, investing is very similar to poker, where you have to make a decision with uncertainty and you're interacting with other parties. And so sometimes if you're betting on a competitive pot where everyone is raising, then that indicates that it may be fully priced or overvalued and it's not a competitive, you're playing a competitive game. And those are generally games you want to avoid. So to give you like a very concrete example. So the end of 2022, healthcare was a very defensive and crowded trade, along with utilities and consumer staples, because we had the most telegraphed recession ever, TM. And fast forward 6 months, healthcare has underperformed cash, utilities are down 5 to 6%. Well, what happened? You had a crowded positioning around defensive names because they were highly consensus. And now, if you look at what's happening in the last few months, you have categories like financials and energy that are outperforming even the NASDAQ 100. The last 1 month, financials and energy are up 4% plus as compared to the NASDAQ 100, a trend that's been continuing over the last few months. So the headline there is your consensus trades are at least fairly priced, sometimes overvalued. And so non-consensus bets create opportunities for potentially less downside because a lot of bad news is already priced in and potentially for more upside if good things start to break.
So, I mean, that goes a little bit to the point of being a contrarian. And I get in a little bit of trouble when I say this, but when you follow the masses, what are the masses? The masses are going to be average specifically for a reason. That doesn't mean that they'll always be that way. And I hope we all could enhance and get better. But you want to go a little bit against the grain. You could argue some of that takes not only guts and forming your own opinion, thinking for yourself, one of my favorite phrases, but sometimes having the dry powder to do so and the time horizon. And that's probably a key thing. But if it was that easy, let me see what most are doing and simply do the opposite, be a hardcore contrarian without giving much thought behind it. That doesn't seem like it's the best way to go either.
You touched on several excellent points. And the other part is like the consensus can be right. Like in the long run, earnings grow, companies grow. We'll talk about population growth later on, what impacts they may have. And so in the long run, asset classes like equities go up and to the right. Appropriate time horizon, of course, is required. And of course, consensus can be right. We're talking about, like, say, the FOMC rate expectations. So the consensus can sometimes be right. So you do need mental flexibility. But I think the thing you pointed out there is having a longer term view. You also talked about having dry powder. It's one of the reasons why I'm excited about distressed commercial real estate. If you look at, say, Charlie Munger, his top three holdings are Berkshire Hathaway, Costco. I think he may have sold Costco, and then multifamily real estate. So participating within a category that throws off cash flow, where you get a depreciation and interest expense tax shield so that you can deploy into new opportunities as they present themselves, is an important part of building a portfolio, right? The real estate market's about $30 trillion in size as compared to US equities, which is 40 trillion. And most people are under owned real estate, but you got to approach it in the right way. So what is the non-consensus way? I'll talk about the consensus way, which is the wrong way, then the non-consensus way. So go back to the 2008 crisis. The way people made money during and after the 08 crisis, it wasn't so much the big short. Even the people that made that trade, they didn't bet enough, or they exited too quickly, or it wasn't the core of their thesis. The way you made money after the 2008 crisis was actually the big long. And it was buying single family houses. And of course, Blackstone did this with Invitation Homes. It wasn't investing in distressed funds, the folks that looked at the Lehman balance sheet and picked off various assets. It was going long orphaned assets and single family residential real estate and multifamily that was in foreclosure. And so if you bring that back to today, what you don't want to do is invest in distressed New York City commercial real estate office or downtown LA, because you have these big private equity funds like Blackstone, like Apollo and KKR that have tons of dry powder waiting to get after that through competitive auction dynamic. However, there are secondary and tertiary markets that are overlooked where you have smaller deal size, $10 to $25 million. Blackstone's not going to get out of bed for that. So you have less competition and you can develop proprietary sourcing. You can get lower cost basis, lower cost of operations in these less competitive markets. That's one example. But there are others as well, like biotech. No one's talking about biotech now. And no one's talking about a category that is worthy of consideration if the long-term outlook is good. So biotech, you're at 10-year valuation lows. One. Two, in the second half of this decade, you're having enormous patent expiry. That's going to drive M&A activity of the majors to acquire small biotech firms. Third, you have a high number of biotech firms trading at below net cash assets. We haven't seen, that's a Buffett type transaction. We haven't seen that.
Yeah, exactly.
And then fourth, we have these drivers. Of course, aging demographics is a big part of that, meaning more consumption of technology. But then within biotech, we're evolving in new kinds of ways. In the past, the innovation was around molecules like Lipitor, which is a statin used to treat cholesterol. But now you have novel biotech technology that we haven't seen before, everything from gene therapy to RNA to antibodies to medtech. The promise of what we saw in 2000 when Craig Venter decoded the genome, there was a disillusionment phase. We had a bubble, didn't deliver. 20 years from now, we're starting to see delivery of that. And one last point, this interacts with AI as well. We're now seeing companies like Schrodinger, for example, that are going to these biotech firms and large pharma companies and saying, look, we're going to rent you our AI technology to do drug discovery, and we'll just share on the upside. We're not going to charge anything on that. And they are finding new treatments. So it's an exciting time. Those are examples of ways to approach non-consensus investing.
No, those are great thoughts. And I am going to have some more questions about that. But also, pardon me, audience, as noted, this is going to be a long form interview. Definitely listening to it live and interacting is the best way at the moment, because basically also opinions change per new information comes in. It's recorded, put up on a platform a month later. Well, conditions change, but also listen to this list of topics that we're going to talk about today. It's wide encompassing. So right now we're in becoming rich with non-consensus actions. We're also going to talk about the youth, maybe college age and younger, how to think and how to make money. We're going to talk about Zuck versus Elon. AI is at the end of the world as we know it, or nirvana. Psychedelics, financial freedom, aka self-sovereignty, where to live in the years ahead, nuclear power, come back and have a profit, and starting a bank. I mean, this is like one podcast that basically is covering everything. So I really look forward to it. But continuing on, so what is crowded today? Do I look at big tech stocks, financials, and energy?
Excellent question. So I'll tell you what's not crowded, and we'll talk about what's crowded. So financials and energy are not crowded. People still have PTSD around the March banking crisis. In Twitter, I was very public, and I actually said now's the time to buy financials, and I talked about specific investments too, which I rarely do. And I'll tell you a little bit more about energy. So if you were to do a random poll and ask someone, what do you think energy futures markets expect the price of oil to be in 2033? These contracts go out 10 years, and you said, here are the options, multiple choice: $50, $70, $120, $180, right? And I think, Angela, you and I had this experiment, right? And most people will say, oh, it's like 150 plus. Actually, futures curves are in steep backwardation, and the answer is around $50. And that's in nominal terms. So we believe that's a wrong view. The rise of ESG and there's a lot of top-down policy driving adoption of renewables, but the physical limits in chemistry and lithium battery technology and the laws of physics and just where the infrastructure around the grids are today, they do not support this thesis of a of a call it a soft landing to renewable energy. We're going to need hydrocarbons. We're also seeing a nuclear renaissance. So those trades are not crowded. People are not discussing a nuclear renaissance. No one's discussing the fact that we have a nuclear reactor going up for the first time in decades in the United States and dozens starting around the world. What is crowded? So AI venture is extraordinarily crowded. We had an opportunity to invest in Anthropic at a multi-billion-dollar valuation. We said no. We'll talk about AI and how to approach that. We do believe there's an incredible opportunity to invest in AI, but it's not directly on its face. You've got to find AI adjacent opportunities. On big tech, I do believe big tech is a crowded trade. Not all of big tech, but certain names within there, and it makes sense to discriminate, really parse that out. And my headline on big tech is as follows: many of these big tech companies are becoming geriatric, meaning their earnings
Yes.
growth is sub 12%. Like Apple's earnings growth is now 6%. There's our earnings expectation. They've actually experienced revenue declines. And people don't realize that what's happening is you have stocks beating lowered guidance. And so they're exceeding on that. And by the way, I still have exposure to big tech, still has a role to play in my portfolio, but I have tilts and I have names I like and I have underweights and other things, et cetera. But that's the big story in big tech. And every 10 years there's a new form factor, right? So after the dot-com bust, what led? It was energy, it was financial, it was also real estate. It was not technology. And then after 10 years of technology walking through the desert with scarce venture capital, you had startup investments in Uber and in Twitter. And it was a great vintage for venture capital. There weren't that many venture funds at the time. And 2010s was the era of big tech. And now here we are in the 2020s, and you're going to find new leadership. And it will not be the leadership we've seen in the 2010s.
Very interesting. And I do want to come back to nuclear and what you mentioned, the first time in decades, and it's getting so little coverage. I wonder why. Well, we're going to get to that in a little while. Staying on the theme that we're staying on now, at least somewhat, how would becoming rich with non-consensus actions, how would you take that from the perspective of banking this year and look at the tremendous benefits, I guess you could say, to one bank specifically, JP Morgan? How would that play into your non-consensus actions?
Right. Well, so owning banks was non-consensus. There's a lot of fear around banks. Even now, there's a lot of discussion on crypto Twitter around challenges to the banking system. And there are challenges to the banking system. I've grown up in banks, and I'm also trying to disrupt banks at the same time. I'm long JPM, but I'm not a customer of JPM because they pay 0% to their depositor. That's why I want to be a shareholder. Right? But I would never bank there. But JPM's got a return on equity of 15% at scale. They're a 300 billion plus market cap bank with over $1.5 trillion in deposits, and they borrow at a lower cost than the federal government. And they invest in assets, and they capture a spread. And what is a bank? A bank is a business that has the ability to borrow at low cost and gets 10 turns of leverage. They borrow short and lend long.
Yes, that says it all.
That's what banks are, right? Banks have more leverage than a hedge fund, substantially more leverage than a hedge fund. Although obviously in the asset side of the balance sheet, they're taking different risks than a hedge fund. They're trying to invest in boring assets that have a small ROA. But that's an example of a non-consensus opportunity. I think now it gets more interesting. No one really knew the direction of how consumer behavior might change in March or April. Like if there was going to be a mimetic effect of people shifting to money markets, then that could have been a negative scenario for the U.S. economy. No one knew that, and that's why I focused on the GSIB banks, the JP Morgans, because they benefit from the flight to quality. So you have to act with where you have conviction and certainty and avoid speculation. Now we know that behavior change didn't happen, meaning there was no dramatic flight to money markets. We did and have seen and continue to see a drawdown in banking system deposits around 8% from peak. And so now there are opportunities in regionals and even small banks and also international banks. Look at UBS. UBS acquisition of Credit Suisse was a gift. Gift is a polite word. Some might say steal. I don't mean steal in a legal sense. but they bought that and it's accretive immediately. And look, there are two banking systems in the world that are credible. One is the United States banking system. If you want to custody your wealth in the United States, you have a wide variety of big banks to choose from. And the second is Switzerland. And within Switzerland, there's one game in time, and it's called UBS. And UBS's business is very simple. It's called wealth management. It's a recurring revenue business. And they're not about investment banking. We have underwriting risk. They're not about proprietary trading. And they're not about lending money to hedge funds, which is what Credit Suisse does or did. So, UBS, I believe, is an interesting non-consensus opportunity. No one's talking about that. I've been long that since the $19 price handle. Now it's in the 21s, up very nice. So those are examples. Within big tech, I do believe NVIDIA. It's funny enough, a lot of people talk about NVIDIA. It's like, how is that non-consensus? It is. It's non-consensus. I've been trying to, here's how I communicate that. There are a lot of people that have fear of heights around NVIDIA, and they feel like, oh, they missed it. I believe NVIDIA is under-owned. And we know the bull thesis for NVIDIA, right? We know that they are a primary direct beneficiary, number one. Number two, they have visibility on their pipeline in terms of their customers. Three, they can control their own outcomes, right? They made it an investment in a startup that's going to spend $800 million back on NVIDIA 8100 chips. So they did a round trip trade and they get the equity upside from that investment. Plus they get the revenue from the CapEx spend of that startup. That was a startup called Inflection. It was also backed by Reid Hoffman and Eric Schmidt and others.
Mm-hmm.
They're going to do more of these kinds of deals. But trends endure, and AI is a trend that's not going to stop anytime soon. There are more players that are entering the data center business that didn't think they were in the data center business, and now they are. And that includes sovereigns, and that includes corporates, and may include players like the Palantir and the IBMs of the world. So is the valuation expensive? Yes, it absolutely is. But it's the wrong lens to look at this. I've studied, I grew up in the dot-com era. What broke Cisco, which was the standard bearer in the dot-com era, was when they missed earnings expectations. That was the key. So if NVIDIA misses earnings expectations and misses their revenue targets, then you're going to see pain. So you got to stay on top of this. And I believe even NVIDIA, it sounds since it's not. And by the way, if you look at, say, the 13F filings for some of my favorite Tiger Cubs, their top holding is NVIDIA at like a 9 to 12% weighting. You look at like Stevie Cohen, 0.72, look at like Lone Pine, etc. NVIDIA is a top holding, and people under own it out of fear.
And actually, because we also have a younger audience as well, and some of the speeches I give at colleges in finance and family offices and the wealthy may not even know 13F in terms of the insight that it gives to what some of the greatest investors, a lot of these very private quote unquote hedge funds, a little bit, it's not always updated. At the moment, of course, it's looking back. But if you could give just the briefest of descriptions so the audience could understand that.
So there's a reporting disclosure requirement whereby hedge funds are required to file Form 13F. You can see it published at the SEC website, and you can take a look there. By the way, caveat, most hedge funds destroy value. They're mostly in the asset management business. They charge
100%.
and they're overrated. And you can mostly ignore people that you see on CNBC. In fact, the best hedge funds are not on CNBC because they're focused on niche capacity constrained strategies that are not scalable. For example, Angela, I remember you and I were talking about non-agency RMBS and structured products post-crisis that did extraordinarily well, funds like Deer Park, et cetera. So, however, there are hedge funds that have skill, very few and far in between, specialty funds that focus on a sector, number one, where there's dispersion. Here's an example, biotech again. Generally, I don't like hedge funds, but now and then they're worth every penny. I was an investor in a hedge fund in 2011 in biotech and still an investor now. What I love about biotech is this. You need to understand clinical trials, phase 1, phase 2, FDA approval likelihood. You need to understand the TAM, the go-to-market, the commercial opportunity, the competitive dynamic, who the likely buyer is. And the hedge fund that we at Lumina invest in, they have 30 to 40 MDs and PhDs organized by vertical. They have deep expertise, and they have a database of all the biotech innovation and the probability of passing to phase one, then phase two, then commercial application, exit, acquisition, and that database is incredible intellectual property, right? Because biotech is a game of lottery tickets. You have these small micro caps. They're either worth zero, they're usually worth zero, or they 20x, 50x, 100x. So the combination of dispersion plus the ability to underwrite and select. If you have those two, if you have the skill and you have dispersion in the category, those are the requirements to generate alpha per the theory of active portfolio management, right?
Oh, for sure. And staying on the bank theme for at least one more question, we mentioned JPM and you look at it as a good opportunity. And we're going to talk deeper into banks and potentially what you're doing a little bit later. But broadly, from an investing perspective, under the auspice of non consensus, how about regional and small banks? From the outside looking in, the public is going to say, are banks in trouble? Look what happened in the US earlier this year. Look at some of the underlying financials, the issues with cash reserves, what happens if there's a run. There's on the surface, there appears to be lots of problems potentially, but
Right.
you're looking at it strictly from maybe an investing perspective. So from that perspective, non-consensus, what would be your opinion on regional and small banks?
Right. So there are opportunities. So first off, on JPM, look, that the easy money is done there. I think now is the time to broaden the wings and consider other opportunities, including not GSIB. So again, I focused on the GSIB category because no one fundamentally knew whether you're going to see dramatic behavior change. But I could tell based on valuation, the quality of the business, access to cheap financing, and a beneficiary of flight to quality, and the fact that they bought First Republic, which I predicted on Twitter, is written up in Business Insider, and they're buying $100 billion of mortgages below price and they're financing at 0%, they're going to make billions in earnings immediately. So that was a JPM thesis. But I think there's still room to run there, but there are other plays that are more interesting. So there are 4,000 banks in the United States, and banks have very different business models from one another, highly differentiated. They might seem like they're the same. You go there, you open a deposit account, but how they lend, the customers they focus on are very different. A good example is First Republic, which is no longer with us. So First Republic, 40x in public markets after General Atlantic took them public. They went from $1 billion to 40 billion before they went to zero because they failed to securitize their mortgage book. You know, I played a small role in the deal team at Merrill where we bought First Republic before we sold it. So in regional and community banks, there are opportunities, but you've got to, you really have to understand liquidity risk. There are banks out there that have taken private insurance, private deposit insurance, that protects them against bank runs. So you got to solve for liquidity risk, number one. Number two, you've got to look for banks that are focused on niche markets, quality customer clientele that's not going to have corporate treasurer, CFO flight risk. You know, the community banks that gather deposits from mom and pop, they're going to do just fine. That category didn't have bank run risk because they're not living on crypto Twitter. So there are opportunities there. You know, there's this First Citizens National, right? They've been a beneficiary of acquiring Silicon Valley Bank. That bank, I'm not recommending that bank, by the way. I'm just giving an illustration. They've had a 13 to 14% long run rate of return, which has exceeded the S&P 500. It's a 160-year-old family-owned bank. It's a boring little bank, and it's a compounder, meets all the criteria of a Buffett business. So there are opportunities within the banking sector, I would say, kind of broadly.
And we're going to get a little bit more into what you're doing in banking, but if I could maybe push back a little bit, just a perspective. Looking back now, the promise of DeFi is maybe not what it might have been a couple of years ago. We'll get a little bit into the crypto aspect of the discussion, but that does potentially impact the future of banking and maybe more so, inevitably, central bank digital currencies. I may look at that and what happened earlier this year, and maybe I do look at things through a bit of a negative lens and say, ooh, like, I don't know if now is really going to be the best time, given some of the things that I just brought up, relative to looking at banks as being a viable structure, specifically from an allocating and investing perspective, especially smaller ones. Where might I be wrong?
Well, you have to focus on quality management. Banks focus on the right opportunity. Most banks have awful management. They're intergenerational businesses passed down from father to son to son. In fact, the number one predictor of whether a bank gets acquired is whether the principal owner of the bank is going to retire and they're 60 or 70 years old. That's the number one predictor whether the bank gets acquired or not. So, banks, there's a joke, they call it the 5-3-5 club. You lend at 5, you borrow at 3 from your depositors, and you go home at 5. And Friday you're at the golf club, right? That's a joke of banking, right? It's a great business and it's subject to little competition, and that's why they're not that innovative. There's a reason why Bezos doesn't have Amazon Bank or Google doesn't have Google Bank, right? There's limited competition. That's partly why it's a great business if you've got world-class management and you're focused on the right customer and you're digital first. And those are opportunities that one can get after. So you've got to pick the right banks. I'm not saying go buy the KBW. I'm not saying go buy the Regional Bank Index or buy XLF. You've got to do good security selection. Banks have a role to play. Like, banks aren't going to go away. Like, banks are the primary means of intermediating credit, starting with the Federal Reserve, right? So banks will continue to centralize, which is unfortunate because regional small banks play a very important role in extending credit to middle America. The big banks are on the coastline. The big banks are ignoring the small guy. They're focused on underwriting General Electric and Boeing and large securitized products issuers, right? So, but banks are not going to go away. It's just the nature of central banking and how regulation works and policy they're not going away. No, but there's an opportunity with blockchain and tokenization. Absolutely, no question about it. I don't think it's an either or. I think there are opportunities to refactor how banks do banking and deliver service to their customers using blockchain technology.
And a brief announcement that I'm sure Ram would also agree with. Everyone, this is for informational and really entertainment purposes. A lot of it is opinion. Ram's, a little bit of mine. And also realize kind of what I said earlier. This is recorded on August 1st. You may hear this a week from now, a month from now, a year from now, and conditions change. Just like a good poker player, we as investors would need to adapt. You have your own situation for risk tolerances, for dry powder, liquidity, for needs, cash needs, etc., risk tolerance, so many different factors. Again, strictly for really entertainment purposes. At the end of the day, the buck stops with you to make your own decisions. And whenever you invest, what could happen? Could happen is you could lose everything. It's always possible. So just a little bit of a heads up. And also, because we're doing this a little differently as a live, but also a recording for my YouTube platforms, I didn't traditionally give my traditional open. At this stage, it's probably not even worth it, but oh, why not? So many of you know me as the founder at Family Office Association, something that I love so much, but I did sell my interest in Family Office Association, still the founder, but a wonderful group leads it now, and I'm sure they're going to do a great job. But yes, I am back and bigger and better, onward and upward than ever before, and launched a couple of enterprises headquartered out of my favorite state, of course, of Wyoming, specifically Jackson Hole. Love it so much. Under Angelo Robles Enterprises, and that is Billionaire Mastermind, SFO Continuity, and Family Office TV. There's actually a fourth, but I'm keeping it a little hush-hush at the moment. Sometime after Labor Day, that will become a little bit more public. They obviously all relate to the family office industry, which is my brand, what I know and what I love. And I hope you have an opportunity. Give it 2 more weeks, August 15th. It kind of is pretty bad now. But August 15th, the relaunch or the rebranding, way more comprehensive, of my personal website, angelorobles.com, which will include all that information that I just noted and opportunities to be interactive with me, to subscribe, to get unique proprietary content and interviews. You're kind of getting a little glimpse now of what I'm doing with Ram, and in the future, some of this kind of in-depth, more thought leadership and even some specific opportunities are going to be something more dedicated to those that are contributors, not just via super chat, although that's very nice as well and happy to help, but really subscribers and members that want to be part of a special community. So stay tuned and enjoy some of the more free opportunities now while you still can. And I hope you're going to love it. Let's go back a little bit to energy. So I have a couple of more questions. Uh, Before I get to that question, something that you said earlier, again, nuclear energy, and it's getting like no coverage. What's happening now in the US, which is very, very intriguing. And it does have to lead me to wonder relative to the big picture of climate change and a lot of things around that. I'm assuming part of it man made. I'll give an inch on that, sure. But I think also it's more complicated than that and not such a simple and easy answer. Is possibly the easy answer nuclear? Like, how come it's just not spoken about as much? And that could be the clean energy answer to solve a lot of problems, assuming regulation doesn't bog it down for decades.
Right. Well, let me frame it up for you. So first off, energy demands are only increasing, right? You can look at the demands that we have, whether it's through data center and AI, electric vehicles, so on and so forth. The energy demands are only increasing. That's one. Two is renewables have great opportunity, but challenges, right? Solar panels don't work at night. Wind turbines only work when they're windy. The effective capture rate of these is around 25 to 35%. Uh, and then if you look at like battery capacity usage and so on, it's there are challenges. So if you go back to in the United States experience, here's a fun fact: 12 days before 3 Mile Island, there was this movie called The China Syndrome that came
Yeah.
out.
Hey, I'm old enough. I know these things.
Well,
You're too young, Rob.
I had to do the, as you said earlier, it's about asking the right question, not always having the answer, having a hypothesis that you're testing. And so I researched this and we said, gee, this movie came out before 3 Mile. It's about a nuclear meltdown is the headline. So the equivalent of like Jaws came out around 3 Mile Island. People had PTSD, of course. In Germany, you've had the Green Party movement, which really fought nuclear energy, and then you had Fukushima in Japan. Uh, Now the pendulum is swinging back, right? Obviously, the geopolitical concerns around dependency on Russian oil are an obvious fact there as well. And again, the limitations around the ability for renewables to pick up the slack. By the way, here's another fun fact. So if you look at the various sources of energy, only about 24% comes from electrical grid. Most of it comes from other
Wow.
sources of energy like natural gas and coal, so or nuclear. So, and then the capacity of the electrical grid to support um, alternative renewable energy isn't there. So you look at what California and New York State have proposed, their guidelines where they want to be in 10 years. The ability to induce that kind of transformation in that quick a time, it's just not there. So these are non-consensus views, and they're not baked into markets. And markets, especially when you have natural hedging markets, they're often wrong. I have a deep respect for U.S. equity capital markets. U.S. equity markets, particularly large caps, are pretty darn efficient. There's some opportunities here and there, but interest rate markets are often wrong, right? We've probably all seen the charts of forward expectations on rates, and markets are always bending down. They get it wrong. And that's also true for oil and futures markets. You have players that are natural hedgers in there, like OPEC, energy producers, and that futures price does not reflect a true rational expectation of where market prices can be, and that can create opportunities.
And I mean, when you look at the big picture of energy, and yeah, it's a complicated picture. I've done a couple of maybe more older, 7 or 8 months ago, podcasts with leading deep thinkers and thought leaders on that. And we could probably do 2 hours on that subject alone, but it is complicated. You have geopolitical issues, the issue with renewables, physical and chemical limits, the need for electrification, what we just said about nuclear power, and maybe some of the, like, how come it's not being spoken about more? Like, there's lots going on here. And how much of it does end up becoming a little bit political?
Well, there is a political component to it, of course. It's an issue that's debated certainly in Europe. It's not debated in the U.S. Like the reflex action of the U.S. is energy independence, and there's a debate around Alaska and so on and so forth, right? I think awareness is coming there. You can see it in prices of these securities. Like if you look at the price of uranium commodities, already. They're up dramatically, and there are bets here that are doing well. Oliver Stone released a documentary on Netflix. I haven't seen it. I think came out a few weeks ago. So I think you're going to see more awareness of this. I think your and my conversation will help with that as well. It's a thesis. It's an investable thesis, and that means people will focus on it.
Okay, but if that is a thesis for something potentially from an investing perspective, and you want to focus more on the nuclear side than traditional oil and gas, give our audience maybe a thought of what they could be looking at in terms of maybe given a very, very short thesis that you have, which probably is recapping one or two of the things that you said on nuclear, and how could they potentially become an investor?
Yeah, so they're uranium miners. There's uranium, the commodity, and there are other producers of nuclear power plants and components. Those are beneficiaries. But by the way, I like the old energy. I want to clarify that. Like Petrobras, the largest proven oil reserves in the Western Hemisphere, and their PE ratio is between 2 to 3x. They've got a 20% dividend yield. Not financial advice. Do your own homework. Consider the role of that investment in a broader diversified portfolio. There's reasons why it does trade at that level. But no, I think old energy, hydrocarbons are not going to go away anytime soon. And so there are opportunities there, right? Old energy is being valued like tobacco, if you remember in the 1990s, where it was reviled. There were class action lawsuits, and there was a shift away of demand. But that's not the case here. The demand for energy is only increasing. So it's not the right pattern.
Is it increasing, Ram, when we have a lessening population?
That's a great question as well. I don't believe that's the case. No. How many devices do we have now? How many? If we see electric vehicles, that seems to be coming due every 10 years. Where are these? Right. That's only going to increase demand for electricity. And again, the desire to electrify the grid, that creates a shift in the composition of energy production from coal and oil to other sources of energy production. So I think you're going to see continued energy demand, right? I mean, fusion is a few decades away from here, and the innovation around superconductivity, we have to see if that's validated. But even if it is, I mean, you're still going to be. I'm not an expert there, of course, but it takes time to commercialize these insights. I mean, look at the genesis of the transistor to when you had the desktop computer, right? It takes lots of time for innovation to be introduced into a manufacturing process, a suitable form factor, into broad-based accessibility. So we have time to go, but it's certainly an exciting time to be alive and see all this innovation in front of us.
I mean, you could say, we'll get into AI a little bit later, but AI and the potential for near free energy could have a boost in productivity, offsetting the other challenges we're having relative to population, quote unquote, decline. So that does bring up a little bit of the question, and you might have answered it with what you mentioned with fusion, about how far away are we to a one-day world, assuming we make it that far, where effectively energy cost could be, if not free, near free.
I think it's decades away.
Okay.
That requires fusion energy, and that's the estimates I've seen are that at best is 20 years. It's one of these things you have to just assess and reassess. Does superconductivity enable or accelerate them in some way? I don't know, but does the promise of an AI or AGI in 8 years? Let's say that's revealed in latter half of this decade, does that then pull forward these other future opportunities around fusion? I don't know, but I don't think it'll be anytime soon. And markets are not perfect discounting mechanisms. They don't truly look 20 to 30 years ahead.
Yeah, sometimes a week ahead is just hard.
Right. Exactly.
Changing the direction a little bit and making my high school and college audience, and maybe even younger, so perhaps even clips from my Instagram or my audience skews much younger. Let's talk a little bit about the youth. Well, I'll define that. Let's broadly call it 22 and under, especially maybe more 16 or 18 to 22, and how to make money. So let's take a little bit of that step back. I'm assuming they have time. They probably have limited skills, although maybe in technology, they're a little more advanced. So, what should they be doing, knowing that we may have the challenges of AI? We have a more competitive world than ever before. And again, I don't mean to be always so Mr. Doomsday, but I do see challenges ahead. What recommendation would you give to the young ones?
It's an incredible time to be young. The best time to be born is somewhere between today and tomorrow. The second best time to be born is 10 years ago or 15 or 20 years ago. So if you are the
I missed
young,
my boat, Rom. A couple of more decades
well,
before
the
that.
advantage you and I have, Angelo, is we've seen these incredible waves of innovation and transformation and changes in the world, like the decline of the Berlin Wall or the collapse of the Soviet Union. So it's yeah, how technology transforms human behavior, I think, is the we have the gift we've had is the benefit of perspective of that, and we're on the precipice now of incredible change ahead. Uh, but if you're young, wow, what an incredible opportunity you have. And I love the way you framed it. I think Novo has a similar quote like this. You know, you have time, but you don't have skills. There are two types of capital in the world. There's financial capital, there's human capital. If you're young, you probably don't have that much financial capital. You probably don't have that much human capital. What is human capital? Those are skills. So acquire and develop skills and be deliberate about that. How do you develop skills? Develop skills by building and shipping. Start a startup. Don't overthink which startup. Don't try to be the next Mark Zuckerberg. Just start something. One of the best experiences I had in college is I took a year off to start a startup and it failed. And I learned an incredible amount of all the things not to do. And it was well worth the price of tuition. So start something, ship something, work with Engineer GPT, here's an idea for you. Someone should go build an AI software tool that automates interviewing of candidates. So you could have a generalist interviewing capability. You could interview by skill set. It could have a standardized set of questions. The AI can double click based on how the candidate responds. And then it can generate a video with timestamps and it can give a score. That would save me an incredible amount of time. I'd be willing to pay thousands of dollars for that kind of software. Someone can go build that. It's not hard software to go build. All the info is out there. So build something. I think the second thing is build a skills roadmap. If you ping me on Twitter, actually share this with my team. I have a framework around concrete skills, so we can be deliberate in coaching talent that we work with. So develop like what are skills? Storytelling skills, probably the most fundamental skill. How you tell stories and summarize is incredibly important. Analytical skills. When you're young, develop analytical skills. Learn from the timeless wisdom of others. You know, I think the great truths and wisdom are timeless, and you keep coming back to the same concepts of investing in yourself, surrounding yourselves with people you can learn from that are older than you, that are younger than you, knowing what your strengths are, knowing what your weaknesses are, getting your weaknesses to a basic standard of at least proficiency or at least acknowledge where they are, developing mastery in certain other skills. We could go on and on around the whole topic of the youth, but I think the major critique that the youth have is, you know, the baby boomers, they could buy a house for $50,000, $100,000, and that was a source of wealth. And they're saying, well, gee, what do I do now? There are opportunities, you know, I think even in the real estate sector, you could start a real estate operator franchise or things to do in that category with banks having to kick out bad assets. And I think the key there is you don't have to live in New York City or SF or LA, which are very expensive areas. Like there are tertiary and secondary cities around the United States, whether it's like Nashville, Tennessee, or Detroit, or Whitefish, Montana, or Jacksonville, Florida, or Tulsa, Oklahoma. And these cities I bring up because we've actually looked at market by market where the population growth is, where job growth is, where there's like a local university, where there's a bit of an ecosystem. And housing is affordable there. Houston, Texas, you can buy a house, you can raise a family. In North Carolina, South Carolina, you can buy homes below replacement cost. So those baby boomer type opportunities are still there, and the interest rate cycle will at some point go in your favor where you can refinance and ride that wave in the future. So I think there are good. It's a great time to be young and have time in your hand, acquire skills, learn, and be productive, make a contribution, and carve your own path in life.
I think that's great advice in general. Couple of comments, maybe one question from there, and then we'll move on. I just seem to notice in this generation, even though they see the opportunities, they're probably the most educated generation. Uh, they maybe have a little bit of fear in them about what the future holds, and they lack a little bit of discipline, taking that first step, moving forward, adapting as you learn, and having more fortitude, not giving up, staying with it, making sacrifices. I mean, and I'm a little bit more experienced from people that reach out to me are often younger men, and like they're even when they're educated, they appear so unsure about the future. They're almost frozen in terms of starting. Like you said, start something. What have you learned? It could be technology, social media focused. I'm just randomly noting that. And yeah, I mean, maybe you won't make it, but the opportunity and skill set that you learn, I just, I go back to what Michael Saylor said in one of my interviews about the most important thing that he learned in college, and he went to MIT, was I learned how to think for myself. And I want to go back to that for really great advice to everyone, not just young. Learn how to form your own thesis. There are misdirects all over the place. There's outdated information being taught. Things are changing so rapidly. And unfortunately, a lot of the professors and a lot of people are not always going to be, quote unquote, the best of the best. But it's up to you as a student to take learning as a responsibility on you and to take action with what you learn and to adapt and pivot and always be a lifelong learner, even well beyond my age, because things are changing so rapidly. There are thoughts that I would have on potential businesses, men and women or whatever. And yes, there are little nuances and differences and advantages that one may have over the other. But we could always save that for an opportunity for something else, maybe something I could even do more on Instagram, because that could be a little bit more focused on that audience. But what would be your comment relative to college? So let me put a negative spin on it, which I kind of hinted at. I'm taking some of the prime years of my life, 18 to 22, and let's assume I'm not going to an Ivy League. I'm not going to Stanford. I'm going to a good, solid college. I'm taking prime years of my life, and let's say my parents are not affluent. I am taking on somewhat of a debt burden. And going back to what I said, think for yourself. How does that all interplay with you with getting the most out of the college experience, including people and networking and growing up, learning how to think for yourself, but also taking the action and doing something?
It's an incredible topic. So first off, the three most fundamental skills that one needs to develop continuously in life are: number one is learning how to learn. That's one. Two is asking excellent questions and pairing that with a skepticism and always attempting to falsify your own hypothesis or theory of the world. That's what we call science. And the third is critical reasoning. And like you said, thinking for yourself. So I have a 4-year-old, a 2-year-old, and an 8-month-old, and I hope that we disrupt college.
We have to.
I
Well, they're not going to bring me in to speak anymore, so let's not talk about that too publicly.
Anyway, I contribute to both my alma maters. I'm grateful for my experience. I did go to an Ivy League school, and I learned a ton there. And I've reflected on this quite a bit. I have 2 boys and a girl. I hope they say one day, Dad, I want to go start a business, and I'd love to say, you know what? Here's like the first year tuition. Go start a business, have fun. You're going to learn a lot more from that experience, from entrepreneurship. But on college, I would say, look, it can be a curse to. Hey, Angela, you still there? I just had an audio issue. You good?
Yes, I'm here.
like it can, in many ways, it can be a curse to go to an Ivy League school. It really is. Let me tell you why. So I have many friends that have gone through this Ivy League pathway, and what happens afterwards, you can go to like this consulting or investment banking track, and you work for an investment bank or hedge fund, and you're making good money, maybe a couple $100,000 a year. After 10 to 12 years, let's say, if you're solid, or if you're not, you get like a corporate job somewhere, right? But they never have true autonomy and freedom and the ability to go create something special. In fact, they're often working for people that weren't as bright or as motivated, as driven as they are. So I have friends. Meanwhile, I have friends that, let's say, went to a University of Michigan, and they are owner operators of incredible real estate businesses, or they're entrepreneurs, and they have they've just built great businesses. And so the downside of going to one of these great schools is you go down these like career tracks, and you're doing what everyone around you does. You become a medic, and you think that's what you're supposed to do because your friends do that. Then you think, oh, I'm supposed to go to like Harvard Business School next and pay more tuition. So I hope we disrupt college. There's still a role for higher education, don't get me wrong. There's a lot of value in a liberal arts education. There's a lot of value in a STEM education. I think we've underinvested in vocational education and training.
100%.
And we also stigmatize people that have not gone to college, which is absurd. Look at Vitalik Buterin, for example. I think what Peter Thiel
Exactly
is extraordinary. Look at these individuals, the founder of a firm. I think that is we should encourage that, and I'm excited to see the potential disruption of higher education.
Yeah, sorely needed. If I had to maybe give a parting comment on that, again, my God, if everyone wants to be an attorney, and I hope not, we have more than enough already, then the value of being an attorney, unless you're maybe really top 1%, it's going to be, there's just so many of them. And the less that people want to, whatever, be a mechanic or be a landscaper, the more valuable that profession becomes. And then taking business concepts coupled with leverage and growth.
College is highly, by the way, if you're contemplating selecting your major, don't pick like English or something like that. Okay. Like focus on subjects that require critical reasoning, that are hard, that are
exactly
and force you to grow. And that, you learn how to learn your limitations. Don't try to optimize for GPA. Throw yourself in the deep end. Also, interdisciplinary learning is critical. That's where the synthesis comes from, when you can marry an insight from history and humanities. And here's a great book, and Angela, you may have heard of this. It's called The Fourth Turning.
Yeah, of course, legendary.
Exactly, legendary, and it's it goes back to your
80 years.
80 years, and how like I'm an elder millennial / Gen X. So the Gen X crowd grew up in the age of the boomers kind of neglecting their kids, right? They didn't. So the Gen X crowd grew up with like higher divorce rates, and we learned independence more and a deep amount of skepticism. And so there was an overreaction the other way with the millennial generation. It was like over investing, helicopter mom, enroll them in 10 different activities. And it goes back to your earlier question around kind of mindset and values and focus. So like that is, I'm glad I learned that subject. I don't know if it's true or not. This is history. We can't do A/B split cell testing, but it causes one to think and reflect and be just a little bit more conscious around how to navigate, the future.
That is true. And I think what I was noting was in Palm Beach, I'm naturally curious, and I introduced myself to people very easily. And basically it was let's call it a landscaper, a property management, if you want to be a little more fancy, driving a Bentley. And I introduced myself, and we had a very short 15-minute, but didn't go to college, went into business, picked up certain principles, was disciplined, realized he could only do so much on his own, and started to build a team. and started to focus on leadership and effectively marketing. And by the way, personal income, late 20s, upper six figures, and investing in real estate, building up a portfolio, and believed within 10 years their portfolio of real estate, stocks, maybe it was a little bit of crypto, would earn more than the $1 million plus of income they would be earning from what they're doing. So don't make the assumption from certain professions that a little bit more deeper thought, discipline, and marketing is going to amplify income in professions that you may not necessarily need to take 4 to 8 or more years or 6, whatever years in school. If I had to pick one skill set that in my interview with billionaires, they talk about with me, that I talk about to younger audiences all the time, that they're likely not taught at home in high school or in college, it basically comes down to selling. Now you could say marketing and selling in today's world, social media, your capability of being really, really good in sales could basically, I don't want to make it sound easy for the young ones. It could almost guarantee, if you put in the work and the effort and learn, a mid 6-figure income. And then what you do with that, what you build upon that, how you invest, what you grow, your discipline, all of that is going to come into play. But I don't want to make this a 2-hour discussion. Sorry about that, but that would be my parting comment to the young ones.
A few other quick reactions to that. First off, wealth creation, you need long-term capital gains, not ordinary income. Now, you may need the income to go invest in the assets to go get the long-term capital gains. And again, your real estate's an attractive category, which we've
for sure
a few times. That's one. Number two is, if you are the top 1% of your field, you will be disproportionately rewarded. So if you are a master specialist, what you do, that's highly, highly valuable. Third is your point on sales. I put that as a sub skill on the broader category of storytelling, but it's important. Sales, I think sometimes has a bad connotation. In sales, you are introducing an idea, you're building confidence, you are unpacking material to engender a behavior change. And that is what leadership is about. And leadership is another incredible skill set. And leadership doesn't mean like managing people. Those are very different things. There's thought leadership, there's product innovation leadership, there's leadership in one's household, there's self-leadership, where it's self-discipline, but that's another key skill I think one should develop.
Of course. And audience, pardon me, given using StreamYard, multiple different platforms, my techie texting me, which we're this relatively new to this, so still figuring some things out, coupled with certain of my platforms that we're streaming on, the questions don't quite yet come through to StreamYard, so I have to look at certain platforms. So it's a little hectic, but I'm listening. I don't usually recommend multitasking because I don't think as humans we actually do such a great job at that. But in this case, I kind of have to a little bit here and there. So pardon me.
One last point on sales. Let me know if Angelo. You good with your technicals or?
Yes, Ram, what was that?
No, sorry. So just last bit on sales. Like one of the best and most humbling experiences I had, I mentioned I was part of a startup when I was 19 in my wayward youth. And I had a cold call. I had to pick up the yellow pages and dial for dollars. And it was incredibly humbling. But you also realize it's not that big a deal. And having those touchstone experiences that you can reference help you, and they serve you well, and you go in the cold water and you realize it's not that big a deal, and you say, gee, if I could do that, then that means I can do this. And so sales is an incredibly valuable skill that people should be conscious of developing. The classic Dale Carnegie book, like that's a good starting point.
Great book.
Right.
How to Win Friends and Influence People.
Exactly. Yep.
Yeah. No, that's a great book. And sales will help you in other personal aspects of your life. You could be rich and successful, but if you don't have what's ever important to you for your personal friendships and your family, I mean, how valuable is that really? So the opportunity of learning how to interact, accept rejection, move forward, be positive, are all things that are going to be incredibly valuable to you as a younger person learn these skill sets, develop, like you said, like I laughed when I saw Wolf of Wall Street and the Belfour character uh, had to make his, what, 500 phone calls a day. And his chair was being kicked by the manager to make sure he didn't get down after two or three didn't work out. Like, and I know that would probably be a little crude to do in today's world, but that he went to college, the character in the movie, but doing that took no skill. That just takes, this is going to make you successful. We have a script that works. Stick with it and just have the guts. God, I probably not even allowed to say that anymore. Just to keep on continually making the calls. We know that if you placed 500 calls, you're going to end up interacting, and I'm making this up, with 20 people. And then as you develop your skill set with them, half of them, you'll take it to the next level. And two or three of them, we may end up getting, quote unquote, a sales from. It's just numbers. The skill set actually isn't that deep. The real sales skill set, you could probably learn a lot, honestly, in 30 days. But
I'd say, when you look at salespeople, I've managed salespeople as I've built various businesses, and there is a power law of distribution and performance of salespeople.
For sure.
Some really have the skill, and we've talked about how to develop that skill and so forth. And I think the athletic mindset is a big part of that. Like you said earlier, the ability to tolerate rejection, the stoic mindset, the ability to be highly goal-oriented helps as well. But it is a highly rewarding function. It goes back to, like, again, the higher education. Folks that go to Ivy League schools, they never go into sales because they're trained to do analysis and not sales. And salespeople get rewarded because they bring in revenue. At my prior startup, Pure IQ, I exited out to Cross River. Highest paid company was my head of sales. Highest paid guy in the company was my head of sales.
Absolutely, and deservingly so. It's very quantifiable, the value they're bringing in.
We want to pay. We want to reward revenue generation. That's a value creation. So it's and look, there are paths to becoming executive. Carly Fiorina, before she was CEO of HP Compaq, she grew up through, like, the revenue office function, right? There are all sorts of examples of this. If you want to become the CEO.
Yeah, and you go to the Ivy League school and you want to be a partner in a legal firm, an accounting firm, a consultancy. Well, guess what makes you a partner? It's driving revenue and bringing in business. Your pure intellect and your knowledge about a given skill set, especially in today's more AI-driven world, or technically large language models, but it's all getting better, is less and less valuable. That's kind of a commodity, to be honest with you, but your capability to drive revenue, that is incredibly valuable, and that's what makes you a partner.
You're absolutely right. I remember this is an experience I had in management consulting, which is where I started right out of school. And I realized that there's a finite set of problems one has in business. For example, new product development is one, go to market, understanding what your customers need, business process optimization, outsourcing, vendor source. There's a finite set of these problems, and there's a framework and a playbook for every one of those. Now, I didn't necessarily know all the frameworks, but I had a basic sense of what they were. And I said, oh, wait a minute. So most of consulting is you're learning these frameworks. And you look at the partners, what the partners are doing is they're not problem solving anymore. It's relationship development, relationship management, one, and two, identifying trends. That's it. And that's what your and my conversations about. What are the trends to stay focused on? And that's why I decided to leave consulting. I said, all right, have I acquired the skill sets I need to acquire? And those were things like analytical skill sets, communication skill sets, client presentation skill sets, the ability to make a good PowerPoint, for example, which I still use seemingly every other day. I said, all right, I think I've learned what I need to learn here. Now it's time to develop other skills.
Let's move on. I was going to say tongue in cheek, but it actually is a little serious. Let's talk a little bit about Zuck, of course, Mark Zuckerberg, for those of you who don't know that, versus Elon. And he just goes by first name, of course. Is this real? Like a couple of weeks ago, I thought it was a farce. Then I thought it was a misdirect. And now I think it actually is probably going to happen. And the question is, should it?
The cage match are you referring to? Or
yes, the cage match.
So, like I'm not Mr. Pop Culture. I have a very constrained information diet, but I believe it'll happen. And the reason why is Elon is a master social marketer, right? Tesla spends zero on ads. He always finds a way to keep himself and his brands in the headlines, including the recent rebrand of Twitter to X. And I think that's part of the strategy. Even his combative relationship with the SEC, it helps support the brand and creates awareness and top of funnel consideration. So I believe it will happen. One, two, it'll help both platforms. You can sure bet there'll be some live streaming. You remember like 2 decades ago, like pay-per-view was a big thing. People spent $40 to see a boxing match.
Yeah, boxing, of course. I still love it.
Right. And people would get together and they'd watch the match. And so it's a sport that has millennia of roots in human culture. And I think it will happen, yes. And I don't watch many of these sports, but I will watch that one. Can't wait to dial into that.
Okay, and I'm going to ask you who you think is going to win. But before I get to that, should the board of directors allow them to be doing this? Suppose one of them gets seriously injured from a mental capacity perspective.
If Elon has multiple executives and operators that are doing the day-to-day running of the business, the only way he can scale himself, right? So the difference between Zuck and Elon is Zuck is building Meta, which is a constellation of these consumer brands, but he's building one empire. And Musk is building multiple empires. Very different approach, right? So between Tesla and SpaceX and the Boring Company, etc., X. So they have very different approaches. But for Elon to do what he's doing at his level and scale, he needs competent executives to own and operate. And focus is excellent. So I think I don't think there's that much downside if there was greater accountability and focus at the CEO level in all these businesses. So if Elon had an injury, I don't think that's going to hurt the enterprise value of those businesses. For Zuck, it could, but I don't think it's really on that. I don't think that they're going to do physical bodily damage that's going to incapacitate one another.
Well, they might. I mean, if it's just jujitsu, which would play to Mark Zuckerberg's advantage, that's his focus, less likely for whatever, like a getting punched in the head, a knockout. There are things that could go wrong. I mean, who knows? I can name some terrible things that I probably won't. But if it is more of a full MMA fight, yeah, there are things that could happen. But I guess now that we brought it up, the audience is, of course, going to want to know what is it, 4 months from now, 6 months from now? Who do you think, that I'll give my opinion, who do you think is going to win?
I have a high conviction view on this one. I'm going to go with Zuck. And here's why. So first off, let me steel man the Musk case. He's got a massive weight advantage. That's probably the bull case for Musk, actually. It's a weight advantage. But here's the difference between Musk and Zuck. Musk, and they're both brilliant in different ways, right? Musk is obviously a long horizon, 30-plus view thinker. And he has insights around opportunities for civilizational change. And he's a problem solver and engineer, and he gets after them. And he can inspire, he can raise capital, and he makes it happen. But he's incredibly high risk. If we did the Monte Carlo on Elon Musk's career, I mean, if you could go back in time and run this 1,000 times forward, SpaceX and Tesla could have gone bankrupt. I mean, you may have read the stories there. I mean, they really were down to dollars in the bank. And in other worlds, would not have seen the Tesla that we know today or SpaceX. Zuck is very, very different. He's highly focused, highly disciplined. He's a grinder. Musk needs the intellectual stimulation of how do I solve this big gargantuan problem of going to Mars or building high-speed rail between two different cities. Zuck is not like that. Consider, for example, that Google and Apple and Microsoft have major data center businesses, and Zuck does not. Meta does not. Why? Because he's very disciplined around M&A. Right? He's bought brands that have been extraordinary wins. He doesn't overpay. He gets the analysis right. Musk spent $40 billion on Twitter. Too much overconfidence. Zuck, he has these missions: visit all 50 states in 1 year. Another one is read a book a week. Now it's jujitsu, and he focuses. One was he was hunting his own animals, right? He has these like missions, and he focuses and he grinds it out, and that self discipline, I think, would serve him well. Whereas Musk, I think he would be distracted by the latest problem or the latest thing that requires his attention. I think he likes putting out fires or stretching his brain in multiple different ways to generate personal satisfaction. So I think what would happen is strategy wise, Zuck would wear Musk out. He would just wait him out in the rounds, just get him fatigued, get him tired. Uh, and then Musk would make mistakes, and then Zuck would take advantage of that.
I think that's a good analysis. I will give mine. And I know I'm going to come across as what a Wyoming redneck, but I think every person should dabble to some degree in combat sports and get experience literally, even if it's just in a dojo or a boxing ring, literally being in the ring and getting hit. I mean, really hit. That's just me. But on to relative this, given a little bit of my experience and my enjoyment of it. If they were to fight right now, I think there's no question that Zuck would win. He's in better shape, and he is he a black belt in jiu-jitsu? He's pretty advanced.
One level
They're,
below, call, yeah.
okay, close. They're both going to have great teams of people. We already see their names, these MMA legends. So they're both going to get great opportunity from great teachers. So you did mention absolutely size does matter. It absolutely does. Now, is Elon's size not necessarily in the best shape? Sure, but I'm going to make the assumption he's going to get down from somewhat of a pudgy 230-ish to probably a better shape 210, 215. I agree. Yeah, Zuckerberg's going to look better with his shirt off. He's going to be more cut, but he's 160 pounds. That's a big weight difference. My advice to Elon would be you're not going to catch up to Zuck on jiu-jitsu at his level in a couple of months. You want to get good at not being taken down. Your takedown defense, you should focus on that. And if it's full MMA, you should focus on your size and your ability to punch and potentially ground and pound. I know that sounds a little violent, but again, this is a fight. I'm just giving the likely direction that I would go. So if you were to give me that, whatever it is, 4 to 6 months out, if it's full MMA, I'm going to go a little on the limb and go the opposite of you, and I'm going to say Musk.
We'll see. I think Musk taps out. I think that's why no one gets a concussion either. But there are a couple of rounds. It's very entertaining, and that's what will ultimately happen.
And on to the next subject, and one that I think we probably should do a deeper dive on at a point in the future. But we have so many topics to cover. We're actually not going to be able to get to all of them, even if we had 3 hours, which I think is going to be hard for me to do. But I don't know. I'm getting into Twitch streaming and all that, and some of them go on for 12, 14 hours. So anything is possible. Who knows? But AI. Of course, I'll ask the question that gets the attention. Is what, like the song from the early 90s? Is it the end of the world as we know it? Or the beginning of a nirvana?
Look, I'm an optimist, and I'm fundamentally in the bullish positive transformation camp, although we're not in the fast takeoff world, and we can unpack all of that. And I've looked at the Meta Llama papers. I actually 20 years ago when we were consulting, we were using non-parametric models. We call them machine learning now, to make forecasts of like consumer credit risk. So it's something, it's a subject matter I've spent some time with. But when I looked at the Meta Llama 2 paper, if you look at the objective function, essentially, which is what describes what the AI solves for, and that's not what OpenAI is, of course, you can see that the approach they're taking is such that it's not going to lead to malevolent AI. It doesn't mean that others might not take approaches that are jailbroken, which are more productive, by the way. You can see the trade-off in the paper. There's a penalty. There's a trade-off between giving helpful answers and safe answers. And there's a penalty when an answer is not quote unquote safe. But fundamentally, I'm in the positive transformation camp. However, the best counter argument is the great filter argument, right? Which is, if you look at the Drake equation, which is like, there are a lot of intelligent life out there. Why haven't we been contacted? One argument is that there's some great filter And well, what one candidate hypothesis for the great filter, could be AI. I think that's an interesting counter argument, but these are things that are fundamentally unknowable and untestable. And I think in some ways it's a Rorschach test for your disposition, although I'd love to ground it in a cold clinical analysis. Fundamentally, I think this is it's a gift for humanity.
And in terms of what the near future, the next year or two could look like, so Chat GPT brought it somewhat, in the face of the public. It was kind of quiet, or the perception, for a while. Then, like, I guess, boom, that hockey stick. And now they have competitors that are likely better than them. Is this a little bit like the browser wars of the 90s, where with Netscape, and just because they're the first that we're familiar with is not an assurance, although they have Microsoft behind them, that they're going to be the winner. How do you think some of this will evolve and play out?
The browser wars. That's an interesting analogy. I think there's a big difference here, which is it's like the CapEx wars and the race for NVIDIA and the race for silicon, which is capacity constrained. That's one. And then two, there's a race for what's the appropriate LLM model configuration. And one of the conclusions I have from looking at the Mata Llama 2 paper is that you're seeing diminishing marginal returns from throwing more hardware at the problem. And you're also seeing now that there are other LLM configurations that can generate a lot of value without as much hardware. So I think there's going to be a lot more research and discovery on how to design LLMs, and that can create a significant lift. Ultimately, the consumers and the enterprises are beneficiaries of this, right? We're getting free AI on tap, which
Yes,
is
or
great.
near free. Yes, for sure.
And it's too early to say who the long-term winners are, although we know who to track. This is why I keenly look at Meta, Microsoft, Apple's, Google's earnings reports. I want to see their commentary. I want to see their focus. I want to see what they're doing when they do the product demos and showcase, and who's betting, who's not. Like, where's Apple in all of this, right? Um, but I think they're obvious winners. We talked about NVIDIA. I mentioned how I think NVIDIA is non-consensus because it's still under-owned, actually. Uh, I think there are other winners on the silicon layer. I think Taiwan Semiconductor, that is, it's still not consensus. It's like a 15 PE ratio. I think there are opportunities there, but I think people know these names. And I think there are other opportunities around, say, ASML, which creates the chip manufacturing components. That's somewhat less known. I think then you have GFS, Global Foundry, which is like the European version of TSMC. They're benefiting from their version of the industrial policy that the U.S. rolled out last year with CHIPS Act. So people are trying to diversify away from Taiwan. And then there are other names if you go down that list. They're like data center focused AI bets, which are trading very cheap because REITs are thrown out the water. And they're big tech firms that rent for them. So you have high customer quality, they specialized skills. And you have infra provider companies like Cloudflare that are, so I think there are a lot of ways to bet on AI without directly betting on, say, Anthropic or OpenAI and these multi-billion-dollar stratospheric valuations, right? By the way, here's another bet on AI I think is very interesting. So I'm in the slow AI takeoff camp. I think for me, that's a very obvious conclusion. I don't know if other people see it the same way, but like corporate top-down adoption is constrained. JP Morgan has said, we can't do this, we can't do that. It's going to be a vertical by vertical approach. It's not a horizontal. The internet delivered productivity gains quickly because you had two apps. You had the email client and you had the browser, and you could learn those two things quickly, and they were introduced by corporate. So you're literally trained on the job. They had the intranet, they correspond on email, you learn quickly, new form factor, easy to adopt. Here, AI needs to be specialized. You need legal AI, you need finance AI, you need medical AI, and those are different applications that need to get built. We don't have a horizontal universal AGI that's going to uplift productivity everywhere all at once. That's years and years away, maybe 5 to 10 years, we'll see. And so it's going to take time to refactor our workflows for entrepreneurs to develop the right AI tools. We're experimenting with these AI tools all the time. Most of them are kind of weak. Some of them are pretty interesting, and some are indispensable. But one beneficiary, I think, are early adopter startups that are deliberate and conscious about incorporating AI into what they do. So if you're a VC, you're going to see in the numbers, you're going to see startups that are far more productive than other startups, and they've got less headcount. And you don't have to know they're using AI, but that will be why. And so that's a way to bet on this. Just bet on startups that have good valuations because they're getting a lot more done with fewer people.
I mean, who would have thought that there would have been a job, what, 8 or 9 months ago called being a prompter relative to using platforms like ChatGPT? Supposedly, there's people being paid hundreds of thousands of dollars a year. The output you're going to get to some degree is dependent on the quality of your questions you're asking and then your follow up and how you narrow that down to really get the depth of the answer that you're looking for. Let me bring that a little bit into a word we haven't used in an hour and a half that I usually use every minute: family offices. So, and it's maybe a little bit of a question for me, but I'm going to put it more directly to you. The impact of large language models, LLM and AI, on the future of the family office. Now, part of it that you'll probably be more familiar with is going to be on the investing front, opportunities to invest, how they're doing it. Are they doing it as an LP? Are they doing some direct investments? How do they know which one is going to be the winner? I have no idea. But the impact on the family office itself. So why don't I leave that as being somewhat open-ended for you?
I have to reflect on that. I'll bounce the question back to you and riff off what you have to say.
Why don't we start on the investing side? So if I'm a family office, I probably have what, on average, 5 or 10% to VC. I'm assuming in today's world, some of that is being allocated towards deep tech and AI. Do I just say, good enough, check the box, that's going to likely drive returns, let the pros do what they're doing? Or
Yeah.
do I need to get more granular, understand what they're doing, and possibly make direct investments?
Yeah, you've got to get more granular. So many family offices, as you know, own their own business, so they've created wealth through some type of business as well. So you have to consider the impacts of that. But yeah, AI is going to change every sector and industry in a transformational way. And you have to consider if there are negative impacts from that and how you position appropriately. Here's a for instance. And by the way, there are other categories that will not be disrupted by AI, and that also creates another set of opportunities. For example, land and real estate. So if productivity and incomes are increasing because we have more output, right? And output equals income at the macro level, then land should benefit. Now you've got to be thoughtful of where the land is and so forth, but that and land is AI proof. So pretty sure about that. Pretty sure real estate is going to do okay with the rise of AI, notwithstanding work from home considerations and market selection, right? Now, how about SaaS? So SaaS is all the rage in VC. SaaS is considered one of the canonical business models, in particular like enterprise SaaS. You get a 20x price to sales multiple. I believe SaaS will be disrupted by AI.
Yes.
Why do you need Carta? What the gap is this: AI needs a more expressive interface. Right now, I'm using GPT. I have this clunky text-based input-output. It kind of reminds me of playing games on MS-DOS in 1992. And so that's the nature of the interaction. Right now, imagine if AI can spin up the appropriate dashboard purpose-built and tailored for the question at hand, right? So imagine we upload our legal agreements around the cap table, and now that's all secured on the blockchain because I'm not going to trust the AI. I need cryptographic security, and that's a way of AI and crypto coming together. And I can validate that through another AI that's inspecting the blockchain, like in an audit function. But the AI can say, here's your cap table, here are recommendations, here's the offer you should make. I don't need Carta. I don't need Salesforce. What I want to do are ask a set of questions and have the AI generate results. And the questions I would ask as a CEO, if I'm inspecting my revenue functions, different than the same questions that my VP of sales would ask. It's different than the set of questions that the sales executive would ask or the sales ops person, right? It's all the same data, but the representation of that is different. So I think SaaS is at high risk with some exceptions, which we could get into. So that should change your approach to investing, no question about it. Um, Real assets benefit from a world of higher productivity. So one should spend more time investing in real assets that are also less prone to disruption. We talked about some of those ideas earlier, but I'll pause there. And happy to
No,
hear.
that's great. I'd say I'll bring back that question to AI in the future and the impact on family offices. I mean, come on, it's obvious, it's inevitable. Part of it's going to be on the investing front that you hinted and gave some commentary on. And part of it's going to simply be in the employment capabilities in traditional roles in the family office. If you're, think for yourself, a creative thinker, if you're an opportunity of a leader, if you're working and communicating properly with the family, that's great. But how about the situations where it's very much built a little bit on a commodity in bookkeeping, to some degree accounting, to some degree some form of legal work? I would even argue some of the capability of some of the higher level, if you're really good at prompting, Chat GPT and others, it's like almost for free that I have a really high level executive assistant, at least on research, and the ability for more. So the challenge with family offices is they're generally too old. They're not keeping pace with the times. And they're okay for now, relative from this perspective, but they're going to have a world of hurt coming to them, which is one of the reasons why I'm working on, and I had a very good podcast about 6 months ago with Dr. Craig Kaplan. Listen to that one. It's about 2.5 hours on AI. And what I will be doing is part of my masterclass series to go along with my sovereign risk, my disaster prep for billionaires, my creating a top 1% family office. I'm in the process now of working on another masterclass on basically AI and the impact on family offices. And if you want to be involved in this community looking forward, especially 3 to 5 years from now, then you're going to have fluidity in the opportunity of AI, understand the impact, and learn how to work with it from a beneficial perspective. So there's lots of changes coming in the family office world. And like many things, family office, it is very, very slow in terms of adapting. And the world is changing. You're going to be left in the dust as a family. And as an executive, your skill set's not going to be as valuable anymore to the generations upcoming and moving forward, and especially the younger generations creating wealth.
Yeah, it's well said. Like it goes back to what we discussed earlier. It's, can you ask the right question? I think prompting is a skill set that's actually a band-aid for where you are now, but the AIs are getting better, the interfaces are changing. But asking the right questions, number one. Number two, the ability to refactor your business. And number three is the capital allocation decision. Are you in a good business? Do you own good assets that will benefit from rising productivity and rising output? Or are you in a portfolio that is at risk of the dramatic change that we're going to see in the next 10 years?
Very well said. And by the way, just a little bit of a comment. This is live, at least those of you that are listening or watching, of course, live. Feel free to interact. It looks like I did get my LinkedIn up and working in my StreamYard platform. So whether it's LinkedIn, YouTube, you should be able to ask a question. Or if you just want to make a comment, that's good too. I appreciate any sort of support or even critical feedback. Just don't give me too much, but that's okay. And those of you, at least on YouTube, can do a super chat and be supportive and really move to the top of the line. And if it's important for you, a shout out, anything like that, I'm happy to be of value. So this is really exciting. Many of you know that I like really deep intellectual discussions, mainly because I'm curious. I think I'm pretty good at what Ram noted, preparing and on the spot asking questions, and having someone as smart as Ram and many of my other guests. I just simply get to learn. I'm just curious and I want to learn. So hopefully you're all along for the ride as well and going to be active in some of my launches and ventures that I'm doing. And you all know how to find me. I'm so active sharing what I'm doing on social media. And again, the rebranding of my personal website, angelorobles.com, that will be all inclusive. Give it again, let's go with the date of August 15th, and then an opportunity to move forward in all that I'm doing in my membership groups, in my master classes, in full, in my family office TV and some of my private intellectual work that I'm doing, as well as coaching. So from a variety of perspectives, really anything and everything. My life, I'm 24/7 dedicated to the family office community. I've been doing it for a long time. I hope I'm still open minded. I think I am. I'm still learning. And a lot of what I wrote, even a year or 2 or 3 years ago, one of them was like a 250 slide PowerPoint. I kind of had to throw it out and start from scratch. Like things are changing and they're changing rapidly in the family office world. So hopefully I'll be able to be of value and accelerate your knowledge incredibly quickly and be of value to you, especially within the single family office community. Let's move on to, let's broadly call it the world of crypto. I could say Web3 and NFTs, and we're going to bring some of that in. I think I need to give a little bit of context. So my audience knows, beginning in COVID, I started to get really, really active in crypto. I read the Tudor Jones white paper and others that initially got me more focused on Bitcoin, then Ethereum, and then really anything and everything in the crypto community. I do not look at that as being a negative. I started not knowing much. I self-educated myself. I thought for myself, and I made decisions. Did I go too overboard? Yep. Did too much of my allocation broadly go to crypto? Yes. So what looked like a genius in the first year, when I'm up 8 or 10x, didn't end up that way. Still net positive, although not by too much. And I learned lessons, like you said when you were younger, Ram, in terms of things you did as a startup entrepreneur and how you could, one, you should form your own thesis. Just because it's something you don't quite understand doesn't mean that it's not good. And even if you don't perfectly understand it, it still may be something, Ram may disagree, that you may want to be active as an investor indirectly. But, like here's what others would say: limit your exposure by your allocation. So maybe limit it to under 1%, then up to 2 or 3%. And then maybe keep it single digits. I let that get out of control, and that was my fault. But if I kept it, if I reallocated assets that were doing nothing towards something that was still in the single digits and it did go to nothing, I'm not going to be happy, but it's not going to be the end of my day. My principle, for the most part, is still, quote unquote, relatively intact. So do I look back and have regrets and wish that I did some things differently? Absolutely. I make mistakes. I have regrets, unfortunately, all the time. But all I could do is learn and have an opportunity to move forward. Do I still believe in the underlying premise of decentralization, of the promise of what Web3 could be, and the opportunity for Bitcoin to be something special moving forward, and potentially others like Ethereum? I'm hopeful. There is no guarantees. But that doesn't mean that I don't want to learn more, that I didn't learn from my experiences, and maybe now knowing to be more careful with my allocation and taking chips off the table sooner is going to be the way to go. Okay, I felt, because I haven't spoke publicly about that, Ram, you were the first one to actually hear that. Since crypto has terrible last year, not necessarily so bad this year, but there's lots going on. So how would you give the audience of family offices, from your perspective, on crypto? And then I'll ask it, but I think we do have to talk a little bit about Ripple, XRP. But why don't we stop there and just go with the broad open-ended questions? Why should families care about Web3 and crypto?
Sure. Well, first off, digital assets has had an incredible year. It's one of the best asset classes, maybe second to, say, NVIDIA, right? So it's an incredible year. And
that is true.
And I think the other part, and by the way, it's another thing that people don't notice, it's underappreciated. These are things that are not in the popular discourse. If you poll someone in your family at the next holiday or barbecue, say, how do you think crypto did this year? How do you think Bitcoin is doing or Ethereum is doing? I don't think you're going to get an answer that corresponds to reality. So again, that goes back to under own. I think the other point you raise as well around, you do have to think about what's the appropriate exposure and the role in the portfolio. The headline around digital assets is get off of zero. Same thing with exercise, get off of zero. Those two things apply. Make sure you do some exercise and get some exposure, but you have to be thoughtful about digital assets and how you get exposure. It is there is, of the 20,000 tokens out there, the vast majority are nonsense. And so you have to focus on quality assets. I consider myself a Buffett of Charlie Munger and Buffett. At the same time, though, I see the promise of digital assets, and you have to have a disciplined framework around how do you think about what is quality, what are the right product cycles, what is going to constrain or encourage the growth of digital assets as it relates to regulation. What are the different adoption use cases, whether it's individual, corporate, influencer, government, etc. So, you need a Sherpa in this category, I think is the headline that I'm sharing there. There's more. We can double click in a few different areas. One might be the product cycle. One might be certain bets that we're making. One could certainly be tokenization, legal frameworks. Ripple, you let me know where you want to go.
Yeah, actually, since I did bring it up, and we'll spend some time, maybe 10 or 15 minutes in crypto, then we'll likely move to a final subject and maybe do a quick round robin. But since I did bring that up, let's broadly call it government intervention with Gensler, with Bitcoin, broadly with other quote unquote and other verbiage that they appear to be somewhat down with Bitcoin, but not as much the other tokens, what may be going on now with Coinbase and what they're maybe looking to do there, and how that interacts with them losing the XRP case or Ripple theoretically, and how that all intertwines. Boy, I'm throwing a lot at you, I know, but I think it's important.
Absolutely, no, it's crucial. So the SEC Chair Gensler has been rebuked by a district court, and it was remarkable to hear Chair Gensler say last week that investors may not benefit from the protection of the federal securities laws. That's quite an admission and a change in posture and approach. And I'm glad to see Congress is starting to consider legislation, although I think we've so much more to do there to unlock the regulation to bring tokenization to life. I liken the current state of digital assets to the financial services or the bank sector in 2008. So exiting the great financial crisis, you have people that lost confidence in the banks. They lost a lot of money in the banks in terms of market cap. There's a tremendous amount of regulation we call the Dodd-Frank. Everyone hated owning banks. And if you bought banks in 2011, plus or minus 1 or 2 years, if you threw a dart at a top 10 bank, you were up 5 to 7x 10 years later. And digital assets has the same kind of revulsion and negative sentiment, and it's been dismissed, and regulation is coming, and that regulation is actually going to be an unlock for institutional adoption. Another part of institutions is they never left. These institutions have these big product innovation groups and teams, and they started years ago, and then 2 or 3 years after they start their work, something's introduced. And that's still happening now. And you're seeing that. SocGen securitized bonds on Ethereum. Credit Suisse has projects. Visa has projects. They're settling on chain with payments with a credit card. So institutions are here. The primary constraint is legal frameworks that would permit more tokenization. And I think within tokenization, there's several opportunities, and they're very distinct, and you need different regulatory frameworks. It's not one size fits all, unfortunately. But the biggest opportunity within that is NFTs, specifically bottoms up creator economy. So enabling influencers and creators to raise funds, Kickstarter style, but let their fans participate in the upside through, say, syndicated royalty streams, all managed on chain through an NFT. And the fans can underwrite the creator. They know the creator, and they can help promote the creator. That's an incredible opportunity. And who are the losers? The publishing houses, which are the tastemakers, where they make a couple bets and they're betting on the biggest names. And you see the creativity out there. Look at what TikTok has done to decentralize creativity, even though it's a centralized platform. All the music discovery that happens on TikTok. Imagine if you can link that to NFT artist creation, and you can apply that to other categories as well, enabling banks to syndicate CRE debt to the local community so that mom and pop can invest alongside a bank in a senior secured bond, so it's suitable. And the banks are suffering from this deposit drawdown. So you can be a hero for the banking system using blockchain technology and create transparency, create liquidity for the banking sector. So tokenization is the big prize to get a big unlock for digital assets.
And in terms of specifically the Ripple XRP case versus the SEC, what Where is that going to lead? And when I think about central bank digital currencies, which I know eventually that's going to be a programmable money variation of it, we don't have the time to get into a deep dive into that today. I may get into that a little bit with my geopolitical discussion tomorrow with Jacob Shapiro, meaning Wednesday, August 2nd. But staying on the theme of that does appear to provide a framework, a blockchain that a lot of companies are, and potentially governments with central bank digital currencies are going to use. I'm not saying I'm go out and buy, whatever Ripple Labs or XRP, but it seems interesting.
Yeah. So there are better frameworks, first off, whether it's the European MiCA framework, Singapore, Japan, and those frameworks are creating pressure on the US to lead and act, and that's inspiring BlackRock. I would not be surprised to see BlackRock put a money market on chain by year end, for example. That's the kind of meta forces at work here. So Ripple is a rebuke for the SEC. It does help Coinbase in certain areas, but not completely. There are different allegations against Coinbase. I believe it does benefit decentralized protocols, and that supports the thesis for digital assets. So year to date at Lumida, we've been doing a lot of these discount to NAV trades, and that's benefited quite well. With the Ripple case, we're now broadening out to quality decentralized assets that we think can benefit from the Ripple ruling. That said, I expect that Ripple would appeal it because Ripple got a win, but also got a loss. They're still liable at the corporate level. They got to contest that. It's just the fees are going to be potentially too high, the fines, and the SEC may appeal it as well. Nevertheless, though, that it was a judge that cited very good case law, but there's still open ends here. So you do have uncertainty. Nevertheless, there's some opportunities, I think, to invest in, quality names in the space.
And in terms of, from the crypto perspective, I hope I didn't lose my. Oh, yes. Yes, I guess I was wrong. I'm wrong, but doesn't mean I'm going to be wrong forever. I did state 2 years ago, there's going to be the example of digital assets are going to be so valuable that under the CIO in a family office, there may be people specifically, not even outsourced, just directly working for that family office, allocating a part of their portfolio as being an expert in digital assets. That fell by the wayside last year. It's being revived a little bit this year. So maybe what I said 2 years ago wasn't so stupid after all. But could you see the point when larger scale family offices are going to do exactly what I said 2 years ago, but I was laughed at, maybe rightfully so last year, and going to have a digital assets expert within the investment team?
And the expert needs their own team too. The pace of innovation, velocity, information in digital assets is extraordinary. It's an incredible amount that's happening here. In the U.S. equities markets, if you have like a client coverage at Goldman, they'll have people cover a couple hundred securities a piece if they're on the trading desk and they know everything about these securities. And look, they update quarterly, so it's actually achievable. In digital assets, there's so much that's happening that you need dedicated focus. You need a Sherpa. And you've got to look at not just the token economics, but the regulation. You got to look at the narrative. You got to look at what's happening with on-chain, on-exchange activity. It's an incredible space, and that creates opportunity. And the opportunity comes from dispersion. So if you have skill and you can identify quality assets, it's a good opportunity. If you can identify quality venture firms, that's another very good source of return generation. One of the best ways to participate in digital assets is identifying high quality early stage venture firms that are valuation sensitive.
Excellent. I mean, 2 or 3 years ago, when my community, the family office world, was barely covering it or was archaic in terms of what they were doing, I was definitely ahead of the curve. Again, arguably too much so. I went overboard. I get it. I made mistakes. But when you push the boundaries, when you're not down the middle, when you're not vanilla, yeah, you are going to stumble and make mistakes. I still will get people, even yesterday, seeing the word crypto in the title that we were going to talk about, saying, Angelo, you're making your recovery now from crypto. You're having these great talks with economists and macro thinkers and geopolitical. Why do you want to sully it by even bringing up the word crypto? It just seems like they're so closed-minded and not open to what they might have learned and how the world works. And I keep on hinting back to this, to think for yourself. The world is different. It is kind of a new world order. And again, if you really don't totally get it, speak to people that do, form your own thesis, and limit your exposure. Maybe it is under 5%. But to just ignore it and say that it's poppycock, it's just completely made up in thin air. Now, like you said, a lot of the so-called shitcoins, that absolutely is the case. And there's frauds out there. We do not have the time, audience, to get into FTX and Sam Bankman-Fried. I have lots of thoughts on that, and I may save that one for Rumble. That's when I could really let it rip and have no censorship or anything like that. So that is why all my platforms, there is going to be some different content on each, which is why you do want to sign up for my Rumble at Angelo Robles Media, which will really go active in about 2 or 3 more weeks. And my other platforms, both my YouTubes, again, Family Office TV and at Family Office, and my LinkedIn, because there's some content that crosses over to everything, but a fair amount of content is going to be specific to that platform and why you want to be interactive with me, which the AngeloRobles.com website in 2 more weeks on August 15th of 2023 will help. But again, in the meantime, definitely sign up for all those platforms. My final question relative to crypto is the direction of Gensler. The perceptions are that a lot of the crypto community is leaving the US and launching in more friendly, quote unquote, jurisdictions. Imagine if this happened in the early 90s, and I know it's not a perfect analogy, I get it, but back with the internet boom, don't we want to be the leader in this country, the leader in terms of what's going on in AI, which we appear to have somewhat of a grasp on, but I think there's intriguing things happening in China. We could save that for a different discussion. But relative to sticking to this topic, relative to crypto, why do we want a lot of young, talented, smart people to leave this country, maybe even drop their citizenship or not look at coming here because they're not going to have the freedoms and opportunity to do what they may want to do in crypto and Web3 and do it in an other jurisdiction? That seems foolish. I think we're making a bad mistake.
No, I agree. And the US will get it right eventually after trying all their options. That's the history of the US. So I have confidence we'll get there. And until we get there, that creates opportunities. In a way, the challenges and the friction create opportunity to build positions in select digital assets that have promise to benefit when clarity does emerge.
Excellent. And yes, I think some of you were wondering, yes, I do hope to get Michael Saylor back on. When he had some of the issues about a year ago when Fox News was showcasing some of it, my interview with him and a question that I asked was one of the ones that they featured. So I don't know if he likes me too much at the moment, but I do respect him. He gave me that great quote, think for yourself. So it's one that I've been doing ever since I interviewed him now about 2.5 years ago. And I do got a lot of thoughts on that. So again, coming up on some future quote unquote platforms, stay tuned. We're heading a little bit to the home stretch. Let's maybe call it 15 or 20 minutes. We'll maybe go a little quicker. And yes, in case you're wondering, I still got pages and pages of notes. Ram and I will talk more offline, but I think what we're going to do is maybe we'll make this a little bit of a monthly series for a couple of months. So perhaps September to follow now that it's August, and then October, and then get feedback from you to how you enjoyed it, maybe the mutual interaction and more interaction from the audience in terms of themes or questions. Things are changing so rapidly that arguably what we're covering now on August 1st, some of the answers and some of the potential solutions in a month or 2 months may simply be different. Again, like poker, conditions change, you have to adapt. So hopefully you're enjoying it. Send me and Ram a note. We look forward to doing more of these. And there still are lots of topics that we could still cover. But in the meantime, maybe focusing in on 1 or 2 final ones. Psychedelics. As an investor in a family office, and maybe even personally, what do I need to know?
So psychedelics are a new trend. And again, half of success is identifying the trend, and the other half is linking your execution and financial capital to the trend. Uh, your psychedelics is coming into the foreground, right? And you see this in a number of different ways, the decriminalization across various states. And that's happening at a faster rate than the legalization of cannabis. And you're also seeing clinical data coming out of Johns Hopkins, NYU, and Imperial College showing the dramatic benefits from psychedelics, whether it's addiction, postpartum depression, uh, PTSD. It really is quite remarkable. Uh, how to approach it investing wise, I don't have a clear answer to this. I have looked at the category. There are a number of publicly traded companies, particularly in the Canadian exchanges, because they have a more permissive federal regulatory framework in Canada. You know, you have Compass Pathways in the U.S. They don't generate revenue, $490 million market cap, Peter Thiel-backed company. There are startups approaching this in different ways. There's specialty VC funds focused on this. That might be a better way to approach it. But the trend that we're conscious of, mindful of, you know, you may want to take a look at some of Michael Pollan's writings, books around this, best-selling author who's been discussing this. Obviously, Tim Ferriss, who has drawn a lot of focus to this category, and for very good reason. You know, if you think about the divorce rates in the United States, for example, I mean, 50% plus divorce rates. You got to wonder how much of that could have been avoided through, you know, psychedelics and the reduction in postpartum depression, or improving how people relate to one another. So I think there's a trend there. TBD on the best way to approach it. We have to make sure we can't let our passions get in the way of a good investment. And you know, it's like, what is the right play? I've looked at a number of opportunities like Field Trip and clinics. They're different businesses. One is called Field Trip, where they have clinics in different areas, and you know, the valuations are a bit much for me, so I haven't pulled the trigger on anything there. But you know, it's something to take a look at. I think the other one, by the way, like ketamine clinics is another one. I think that in general, the rise of psychedelics is a theme to consider and focus on.
What would you say would be a negative from the perspective of looking at psychedelics in terms of uh, maybe not even as much from an investing perspective, but so simply from a personal perspective? Are there other better solutions? What are some of the drawbacks, or what could go wrong? Unsupervised, maybe being one.
You know, first off, if you want to explore this, you should consider a clinical trial with supervision from a licensed uh, medical university, right? So, you know, that would be number one. Number two, don't try this at home. I'm not recommending usage of psychedelics. Do your own research, do your own homework, comply with the law. Okay. So, uh, you know, yeah, there are cases where schizophrenics, for example, have negative dispositions to psychedelics, and you know, there are bad stories that are out there, sure. So you know, you have to do your homework, and you know, you should seek supervision and professional guidance and care. We're still in the discovery mode around this. The clinical data is remarkable. It's strong, right? It's very compelling. Like smoking cessation, heroin cessation of heroin addiction in one trial,
Wow.
cessation of depression. It's amazing. Now, and the data also shows there are these like relapse curves, at least as it relates to depression. So every 3 months, one might need to, you know, re-engage. But so we're still learning a lot. It's not for everyone. There are risk factors. You know, seek supervision. These are very powerful psychedelics, and you know, you need to seek guidance and care, and you know what you're doing.
Of course, of course. Yeah, I mean, this may relate a little bit. We're not going to have a discussion today about cannabis, but cannabis and psychedelics, the impact from a mental health perspective and the value to society. I'm not overly fluent in it. 3 summers ago, I had 2 interviews on my then effectively daily Zoom with some very intriguing people relative to it. I should go back and actually watch them. One of them, I was pretty creative in terms of some questions, if I may say so myself, that I had. I wish I could have gave it a little more attention, and maybe now I'm turning my attention a little more to even the investing aspect of it in terms of regulatory issues with the government. I don't know if you wanted to touch a little bit on the cannabis aspect and psychedelics. I look at them as being separate, but some people may quasi lump them together. How are things looking from legislation? As an investor, what should I be looking at?
So they're distinct. I mean, the use cases around psychedelic therapy are far broader than the use cases around cannabis. And as I mentioned, the decriminalization is happening at a much faster pace. We need more clinical data. It takes time for that to happen. It's coming out though over the next few years, and then that would enable the FDA to fast track different therapies, and that creates different kinds of solutions that, we talked about biotech earlier, and certain firms will be able to invest and get after that. I don't think we're seeing much on the legislative front. So it really is state by state driven. Family offices are folks in this topic. I was talking to a large family office. They own an island off of Greece, and they cultivate like magic mushrooms there. It was really funny, kind of nice. I was like, my mind was just kind of blown from that. Like, huh? So yeah, there are, look, the Silicon Valley crowd, the entrepreneur crowd, there's like a microdosing that's emerged as a phenomena out there as well. So kind of early adopters of new technologies, let's say, we are going through that S curve, and it figures into this larger concept of well-being and living longer and improving quality of one's life.
Excellent. And I see a couple of questions have popped in, more so comments from the audience, and thank you. Please keep comments coming. They don't all have to be super chats, but that would be nice. But I know one person noted, thank you for bringing up crypto. And again, I formed my own thesis. I dived into it, and to my credit, and I went overboard. To my credit, oh boy, did I allocate to it. I wasn't just that. There was no 1, 5, 10, or 20%. It was a lot more than that. So again, I learned a lesson. I made a mistake. But yes, did I put my money where my mouth was? 100%. And again, a lesson learned. I'm still broadly a believer in some of it, disappointed by others. And I'm still holding promise. We didn't really get too much into, you went a little bit down some of those directions, Ram, with the underlying technology and tokenization, the impact of NFTs and what that could mean, social tokens, which were hinted at a little bit with a creator and some of the value there, how that ties into Web3. We didn't even touch into the metaverse. So yes, those of you that are crypto advocates, I didn't forget everything in 2 or 3 years. I just don't talk about it as much because I want to be more diverse in terms of topics and investing and non-investing. But I am going to look to have Michael Saylor and other guests, and because it still could be impactful for families. So they still should learn. And the thesis, whether it's psychedelics, whether it's cannabis, whether it's crypto, form your own thesis. And the thesis may be, I'm not going to invest, but at least you put in some time and effort to form that thesis. And that's what's important. I think the final topic, it could be a little intense, but a little lighthearted as well. So maybe it's a good way to kind of wrap things up. I'm fascinated by what I would call financial freedom, which we hinted at with the young ones about entrepreneurship and growing wealth, owning assets that appreciate, that produce income, where you're making more money from your investments than you are even at a so-called high-paying entrepreneurship or job. So financial freedom, AKA self-sovereignty. Now that gets a little more complicated for US citizens because our tax structure follows you all around the world. Trust me, I'm pretty fluid given my sovereign risk for families and my disaster prep for families. I'm very, 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 very fluid in a lot of those subjects. And this is one that is of great interest to me. So I'm going to get a little bit more deep dive, but why don't I start with that concept of financial freedom and self-sovereignty? Ram, if you don't mind, I'm going to give 30 seconds on it because I am asked this question by, again, I don't know why young people are fascinated by me. I'm kind of boring, but nonetheless, they might have their reasons. I do believe, and I know this may sound a little greedy and whatever word you want to use to people, The reality is money does matter. It does have some impact on your ability for happiness because it allows you to take care of your family, your loved ones, and provide freedom. Look at Maslow's hierarchy in terms of what? Food, shelter, etc. To ignore that, we're simply just being foolish and being very quote unquote politically correct. Just stop it. So, or stop the cap, as the young ones say. That means stop the lie. Just be direct and honest. Keep it 100%. So, what amount of money provides a level of financial freedom? I personally can't answer that directly for any individual because it does vary. That being said, that's a boring answer, isn't it? You're going to want me to give you some ballpark number where you have a level of financial flexibility. You could have passports in multiple countries. You're buying your way in through real estate and bonds. You're having flexibility with multiple banks. You're owning real estate. You're owning crypto. You're owning a cash reserve, stocks, etc. You likely have more than one home, and you have a level of freedom if something were to go wrong. And yes, lots of things could go wrong. I'm going to say ballpark 30 to 50 million. Now, no, you're not going to be able to get a private jet. You're definitely not going to be able to buy a sports team. There's different brackets of wealth from that level to, I would say, 150 to 200 million, 200 million, half a billion. And then really, you kind of have, I think, unless you want to build the world's biggest yacht, all that you'd ever need, unless, and again, this comes up with the multi-billionaires. I know, I talk to them. I want to buy a sports team. And even having multiple billions isn't enough. You're going to have to likely bring in other investors, use leverage, etc. But on that note, why don't I throw that open-ended question to you on what do you define as financial freedom and quote unquote self-sovereignty?
Great question. First off, sports team, also crowded trade. Good time to sell is probably now. We're seeing that in the headlines to PGA Live, all the rest. So I think just briefly on your prior comments, like there's a role for digital assets in your portfolio, but yeah, you're thinking about portfolio construction, diversification, and make sure you can pay your bills and really take a thoughtful approach to how you build your portfolio so you can weather the storms and lean in when there's dislocation opportunity. I think one of the opportunities now is really around distressed real estate. Every 10 years, you get an opportunity around real estate, whether it's through foreclosure or where you are in the interest rate cycle. That's one of those times now. And there are just so many benefits from the tax code that benefit real estate investors, not just depreciation and interest expense tax shield, but also things like 1031D exchange. There's quite a few real estate millionaires next door and real estate billionaires, for example, like Barry Stern, like who created his wealth in real estate, from scratch. So now is a really exceptional time to consider real estate. And if you don't have the skills, go through a manager, a specialized manager that has a track record, knows what they're doing, has GP, LP alignment, they've skin in the game, they've done this before, et cetera, et cetera. So we have education around that. You can ping me at lumina.com. Our team will share our research around that, how to approach it. So I think financial freedom means you get to control your time and where you place your time. That's fundamentally what it is, right? If you are post-economic, the thing you value most is your time. And so how do you generate a portfolio that allows you to have full control of your time? And that also means you need to think about a portfolio that's resilient to different possible states in the world. You have to have a portfolio that is resilient to, for example, an inflation that might be higher for longer, or to a period where there's a melt up, or to a period where excessive quantitative tightening causes asset price reduction. So you need to have a very thoughtful portfolio. Like the next 10 years will be very different from the last 10 years. In the last 10 years, we had quantitative easing to the tune of $9 trillion, ultra low interest rates, and asset classes were up and to the right. Now, the next 10 years are not like that. So, I think step one is being thoughtful about portfolio construction. Step two, within that, it's very important to have assets that cash flow and tax efficiently. And also appreciate over the long run. Again, I go back to real estate. This is one of those times where you're supposed to build a real estate portfolio, right? It's like real estate's $30 trillion asset class. U.S. equities are $40 trillion. I would wager to bet that most people in your audience are underexposed to that category. And it can contribute to a barbell portfolio where you can take more speculative wealth creation, long-term capital gains opportunities, but you can fund it with the cash flow. And this is part of the magic of Warren Buffett. He applies the principles of real estate investment. He has 80 wholly owned companies. He's able to offset passive income from one with passive losses from the other. He has depreciation from his capital expenditures. He's doing capital allocation across that. He's using leverage. He's doing permanent capital carry trades, borrowing long and lending long. And that real estate has all those properties. So we might not be able to go acquire a company like Warren Buffett, but we can acquire real estate. I think that's an exceptional opportunity in this period of time.
Yeah, that's an excellent thought. It reminds me, for the young ones, but really for everyone, one discussion, not really a debate, but that I was going to do, and preferably with someone non-independent, was kind of stocks versus real estate, the advantage to each, and there are advantages, but I still think there are certain advantages for a U.S. citizen in real estate that are very intriguing, but it's very geographic centric. And lately, especially since COVID, like, what are you going to be investing in from a real estate perspective? How much to put down? Is it a multifamily? Is it a storage facility? Suppose it's office, but where? That would be an interesting discussion in the future. We're not going to dive too deeply into it now. Staying a little bit on that final topic, I guess, like, Ram, like, where would, maybe here in the US and abroad, someone who wants to develop wealth, has wealth, earned it, and has a little bit of financial freedom? Now, again, if they're a US citizen, they may not have tax freedom. Okay, they may be willing to sacrifice that to remain a US citizen, but where would you recommend that they consider living in the US and opportunities abroad?
I think part of it depends on age and where you are in your life cycle, right? If you are at or near retirement, you should consider the blue zones. If you're focused on longevity and quality of life, the blue zones are these areas where you have these centenarians, a high incidence rate of centenarians, whether it's the Amalfi Coast, islands off of Japan, Costa Rica, etc. Very good quality of life, good community, very good diet, good sunshine, very pedestrian-oriented communities that will give you good longevity benefit. That's one. If you're younger and you're in the US, I would consider, I mentioned a few of these areas earlier. Again, it depends on the kind of approach you want to take with your life too. If you're focusing more on the real estate trajectory, Jacksonville, Nashville, Tennessee, Detroit is a really interesting turnaround story. Salt Lake City, Utah. So there are these secondary and tertiary markets that Houston, Texas, if you're interested in energy, great quality of life, housing is affordable, great schools, everything you want there. If you want to have a family, you just got to avoid major metro. Now, if you're in there is a value to being in cities. I'm grateful that I spent 2 decades in New York City. The culture, the dynamism, the creativity, the average intelligence of the population, the ability to learn and grow is dramatic, and it's incredible. Spending a couple of years there may be worth your while, but it need not be. It's not a requirement. It really depends on the journey you want to carve out for yourself in life.
Interesting. I'll give from my global travels and my interest in the subject. I do agree with you. The Blue Zone's great book. So Costa Rica is amazing, the Amalfi Coast, Italy in general, and actually some interesting tax benefits in Italy that you wouldn't have expected. Now, the bureaucracy there is brutal. I have an upcoming discussion with the movie Coming to America with Eddie Murphy in the 80s. We're calling it Coming from America. So Americans looking to go abroad. I don't want to get the date mixed up. It's actually on another platform. We're on the guest host. I believe it's September 30th, but my audiences will get notices about it per my social media post. But yes, I do agree. Now, in today's world, you don't have to be necessarily older. Maybe you're a young entrepreneur, but a lot of the work you do is digital. you have freedom and flexibility in terms of being a true nomad. Not every one of my listeners is a US citizen. So you could have your core citizenship in another country that doesn't have an onerous system like the IRS does here in the US, or the US does with the IRS, relative to following you everywhere, that may be more income dependent on the country that you're earning income in. See your tax advisor. But yes, you also want to have happiness and enjoyment and sunshine, people, good food, good company, a vibrant, maybe entrepreneurial culture, or whatever you're looking for. Portugal's kind of intriguing. In terms of here in the US, I'm going to basically concur with you, but maybe be a little controversial on some things. I am not as much of a city person. I do enjoy the city. I love going to New York occasionally, to LA, and I really love Miami. It's so vibrant and so multicultural, great restaurants, great food. I know a lot of the universities, a lot of the young people prefer more the interaction there. And those are all, I want you to be happy. Don't be totally driven by taxation, blah, blah, blah. But I do have to wonder, like, why the hell would anyone start a business, especially with employees in California or in New York? Like, I don't get it. And I know I'm echoing a little bit of Mr. Wonderful from Shark Tank, and I did a little post on this as well. Completely agree. Like, South Dakota actually is an amazing state, an amazing state. I personally prefer Wyoming. That's my choice, the true cowboy state. It's not Texas, by the way. And I love you, Texas, but it really is Wyoming. Now, again, in today's world, being a little bit more of a digital nomad and having the opportunity to be tech savvy may give you freedoms that people didn't have 10 or 20 years ago before retirement, while they're still building companies to live wherever they want and have a certain level of self-sovereignty and freedom, even within a country. So I would also look at Nevada, Wyoming. Montana does have taxes, but they're great on other things. And again, at the end of the day, be happy. Florida and Texas are very trendy. No state tax, business friendly, infrastructure, although they're both being a little bit overwhelmed. Prices are skyrocketing. That would be, I could argue, a negative, unless money is just no obstacle whatsoever. But there are still certain advantages in certain states that are very protective of personal freedoms and privacy. And Wyoming definitely is great at that, and unique with what they're doing too from the crypto perspective with, Governor Loomis and all that. So again, we actually have some interesting people coming up in the next 2 months that could talk about that further. And this will be a subject that we'll dive more deeply into. Ram, I'm going to give you a chance before my close to give any parting comment. I know we didn't necessarily have a chance to go a little bit more into Puerto Rico, a little bit more of banks, but again, would very much look forward to doing that and many other subjects in September and October as well, and making this a little, at minimum, a 3-part series. But let our audience know a little bit of maybe a recap from your perspective, what to look forward to and how to reach out to you and your firm.
Sure. So a couple of quick thoughts to conclude there. So to your point, by the way, on the international front, I agree. Portugal, Berlin, Singapore, those are great hubs of innovation and entrepreneurial dynamic. And if you're in the US, if you want to live in SF or New York, it's because of the engineering and venture and angel ecosystem. That would be the reason why. To your point, if you're a digital nomad and you can assemble a global team, and I have a friend, he had a Discord channel, assembled a global team, built and exited his company, and all his talent was sourced internationally. So you're choosing which kind of adventure you want to play based on where you live. You can learn more about Lumina Wealth at our website, lumina.com. You can subscribe to our newsletter there. We publish it every Sunday. And I have a Twitter at Ram Alawalia. You can see the spelling of my name there. And also at Lumina Wealth. We're creating more content, more research. This has been a tremendous amount of fun. In terms of recap, I think one is, number one, think for yourself, do your own research, critical reading. Number two is focus on asking the good questions and testing your hypothesis. And third is, never stop learning. Learn from people that are older than you, learn the timeless wisdom, learn from the people that are younger than you, and be conscious and deliberate about developing your skills and the information that you consume and who you surround yourself with.
That's excellent parting advice. And everyone, that is Ram, R-A-M. Last name is spelled A-H-L-U-W-A-L-I-A. Again, I've known Ram for a number of years. He always, speaking of asking great questions, like he may be the best at that. So it's really a pleasure to call him a friend, and active in the wealth and family office community, which of course I love. And again, his amazing firm is called Lumida, Lumida. Have an opportunity to reach out, follow him on social media. He's very active on Twitter and LinkedIn. Did you have a specific handle, Ram? Is it on Twitter?
Yeah, it's at Ram Alawali. It's my name there, and you'll and Lumida is a private wealth firm. We focus on delivering advice to high net worth, ultra net worth, and especially around alternative investments, where we see a lot of opportunity, including some of the themes we've discussed, today, whether it's digital assets, distressed commercial real estate, biotech, energy, and pairing that with a thoughtful approach on service, trust, tax, and estate. How do you weave that together to get the best after-tax return on your investments? How do you think about intergenerational wealth transfer, all the rest? So we're having a lot of fun.
No, you sure are. It's been a pleasure to reconnect. Look forward to hopefully doing this again, recapping certain subjects, but moving into new ones, from banking to others, from you even looking to launch and start a bank, and just so many different topics we could talk about. So as a near 2.5 hour part one, this wasn't so bad. This was a lot of fun. It was a great honor and pleasure for me. I basically concur, make my life easy with your parting comments. Again, think for yourself. What I did learn a little bit from having Ray Dalio speak at my event and reading some of his work, and I impart it in some of my master classes that I teach, the number one important thing for a family office to be successful is going to be its people. Get the right people in the right bus. That's more of a Jim Collins. But he says competent and competency could always be worked on. Don't rest on your laurels. Realize that you have blind spots. No one's perfect. And don't let ego get in the way. You probably, if you're in that position, have had some successes, and kudos to you. That's a great thing. But realize that's old now. You have to move forward and still produce. People have a short memory. They remember, what have you done for me lately? And that's going to apply more and more in family offices as well. You always have to work on getting better. You have to open yourself up to mentorship. And that includes having more respect in this country for older people and all they could teach you. But I'm also going to surprise the young ones a little bit. We, the older generation, boomers, X, even you old millennials, you're getting up there if you're on the latter part of it. We have so much to learn from a lot of the young people who are so tech savvy, so vibrant. And yeah, I disagree with them on a lot of things. You want me to be really keep it 100 and be honest with you. But that doesn't mean that I don't learn, that I don't respect their opinion. I may not want to listen to it, but I'm going to listen to it. I may not want to act on it. So, but it is important that they do also have much to teach you. So this has been great. And again, everyone, if you enjoyed it, please follow me on my socials. And I'm active on so many of them, even things like Twitch that I'm really new at, and Rumble. I believe both are Angelo Robles Media. My LinkedIn, many of you are more familiar with me already. Simply, you'll find me. It's Angelo Robles, and 2 YouTubes. And you'll really have to subscribe to both because they will have some different content. That's at Family Office. I got that years ago. Great name. And that's who I am. Come on, the Family Office guy. So at Family Office, and my newer one, Family Office TV. Go and subscribe to that. I got some amazing interviews that are up on there. And maybe I may leave that as being exclusive to that platform at Family Office TV. And again, it's free. And yes, as many of you know, by August 15th, I'll have the relaunch of AngeloRobles.com. A lot of that will tie in all together and talk about my masterclasses, talk about my membership opportunity to be a part of what we're doing around the world. I'll talk more about my travel schedule, going to Germany in October and speaking in front of a bunch of centimillionaires there, their goals, their aspirations, creating a family office. This is really an exciting time. And Ram noted that as well, but a very, very volatile time as well. So do understand that. It's intriguing, a little scary, and a little fun, I guess you could say, at the same time. I've dedicated myself to this community in the family office world. Join and be a part of what I'm doing in socials and with my organization. I promise to be of value and be definitely committed to the industry. I'm a little different. I look a little different. I'm wired a little different. Again, it's a boring community. I try to add a little bit of deep intellectual bravado, a little bit of pushing certain boundaries, and make it hopefully a little bit fun, although maybe I could work on my comedic skills just a little bit more. But I hope you're enjoying it so far. By now, my God, you all know how to reach me. I probably give more infomercials than anyone else in the family office world, but hopefully in between that, providing some value as well. Thank you all so much. I look forward to the next time. And by the way, the next time on live is tomorrow. It's Wednesday, August 2nd. I may not have enough time to give it a big promotion. It's Jacob Shapiro. It's geopolitical. We kind of have differences of opinion, but I respect other opinions. So that's going to be a very intriguing 1.5 to 2 hour discussion at 2 p.m. Eastern tomorrow, and it will be on my live programs. Thank you all so much. And Ram, again, thanks for being an amazing guest. I appreciate it.
Thank you. I really appreciate it, Angelo. This is terrific.
My pleasure. Bye-bye.
Be well.